Okay, I just want to make sure if there's anybody of a contrary view, they say so. Right, in that case, I'll welcome members and our guests to the Pension Committee. I would remind everybody that we are being recorded and streamed out on YouTube. So we'll start with the agenda. David Wilkes, do we have any apologies?
We don't. Before we do that, I think we just need to, because this is a virtual meeting, we just need to explain the etiquette that you would like us to follow for the meeting. I think. Okay,
I'll do that. Thank you. We have no apologies. The etiquette is that members of the meeting should introduce themselves when they speak, and they should request to speak by either putting RTS request to speak in the chat line or raising their hand. Either way, I will try and keep an eye out. If you can mute in the meantime, if guests could mute and turn their video off generally unless they're speaking. If all questions and comments could go through the chair, and if we can be quite deliberate in our actions this morning, A, because life is slightly more difficult in the virtual world, and B, because it's important that everybody understands what we're doing and why we're doing it. Does anybody have any issues with what I've just said? David, do you have anything you wish me to add?
No, thank you, Councillor Wolf.
Thank you. Item 2 is declarations of interest. Does anybody wish to declare any items of interest related to any part of this meeting? If so, please raise your hand or put something in the chat box.
It looks as though we now have Councillor Canning back.
Councillor Canning, are you back on board? Councillor Canning, if you can hear me, as soon as you're back on board, could you unmute yourself and say, I'm back in, and then I will hand over to you. I'm assuming you've heard that, and if you haven't, I'm assuming you'll come back in. Item 3 is the terms of reference, and we repeat these at each meeting, particularly for members of the public who may have come in and not been in this sort of meeting before. The Pension Fund Committee is primarily responsible for all the functions of the Council as the administering authority of the Dorset Pension Fund. The committee will consist of 9 members, comprising 5 members appointed by full Council, not more than 2 also being appointed to the Cabinet, and 3 persons appointed by Bournemouth, Christchurch and Poole Council, and 1 person nominated by the unions who have membership that includes officers. Yeah. If when you introduce yourself, you could indicate which group you come from. And can I just reiterate that we represent not only the 2 councils, but we represent over 200 other bodies who invest in our pension fund. Somebody's speaking in the background. Did they want to say something? No?
Hello, Peter.
Yes, Andy.
Yeah, at the moment I can't I see you all, but I can't. Unfortunately, the sound's not working, so all I have to do is probably close it down and re-log back on again. But I guess if you carry on for the time being, then hopefully I'll be able to join you properly in a few minutes' time.
Okay, as soon as you come on, please let me know, and I will hand straight back to you. At the moment,
thank you very much.
Andy, if I may, Peter.
Yeah.
Andy, I have the same problem. I'm having to use the headphones for speaking, but I can only get volume through the computer.
Right.
If that helps you.
Okay, Andy.
Yeah.
Let's not go into the technical details too much. You log back out, log back in, and we hope to see you shortly.
Okay, thanks very much.
Thanks. Can I move to item 4, which is the minutes of the last meeting? Are there any issues to do with the accuracy of these minutes? I see no hands or nothing in the chat box, so I'll assume the accuracy is fine. Andy Canning, we now have a picture of you, so when you speak, I will hand over to you. Right. No. Okay. Are there any issues on the minutes that people wish to raise as a matter of urgency, which I've not been notified of, which they think should be covered under any other business? I've got a hand. Oh no, I've got a participant. Who's that? For some reason or other, my hand is raised. I apologise. That's not intentional. ignore it. Right. So everybody is comfortable with the minutes that they should be signed as an accurate and true record of the last meeting, which was held on Thursday, the 12th of March 2020. I'll now move to the first item, which is public participation, and we received questions or statements on the business of the committee from town and parish councils and members of the public. David Wilkes, you have the questions. Can you tell me who's reading the questions, please?
Shall I? It was going to be the chairman, but shall I do it?
Yes, please.
Thank you. So we've had a number of questions from members of the public relating to the pension fund's investments in fossil fuels. The review of the investment strategy to be considered later on the agenda of this meeting will address these matters, and therefore we do not intend to respond to each question in turn now. However, a full record of all questions and responses will be published as part of the minutes of this meeting, and as committee members you will have received copies of those questions this morning. In addition to the questions from the members of the public, we also have two questions from a Dorset Council councillor, from Councillor John Orrell. The first question is asks, is the council exposed to losses from investments in the commercial property sector that is predicted to experience turbulence as loans face default in the hostile environment of lockdowns and the shift to online sales? The response to the question is, in order to diversify sources of investment return and risk, the pension fund has investments across a wide variety of different asset classes, including commercial property, which in turn has a wide diversification both geographically and across sectors. This strategy of diversification means that exposures to losses in any one asset class or sector are reduced,
is now joining,
but not eliminated. The shift towards online sales was already in progress before the pandemic, and consequently, the pension fund has less exposure to property in the retail sector than in the benchmark or industry average. The second question from Councillor Orrell was in relation to fossil fuel investments, and again, as before, this is covered by the review of the strategy later on the agenda.
Thank you very much. Thank you very much, David Wilkes. I'm very grateful for that, and I repeat, those questions will be a matter of public record and the answers will be a matter of public record. Item 6 is urgent items. I have no urgent items that have been notified to myself. David Wilkes, have there been any urgent items that has been notified to the chairman that I'm unaware of?
No, there have not.
Okay. It's just not working in terms of the laptop, but I can see all of you, and on the phone I think it will work as well. So I'm going to give it a shot and see if we can make this work.
Okay, in that case, I have just completed item 6. We're now on item 7, review of the investment strategy on pages 11 to 46. I now formally hand over to you and I will go on mute.
That's great. Thank you very much. Right, David, if you wanted to introduce this item, please.
Thank you, Chairman. The conclusions of the review are set out in the executive summary. Before I talk through those, though, I thought it might be useful just to give some context to the recommendations that committee members are being asked to consider today. So, a reminder that the LGPS, Local Government Pension Scheme, is a defined benefit scheme. So benefits are calculated based on factors such as age, length of membership, and salary records. They are not directly linked to the investment performance of the assets in the pension fund. These benefits are funded from contributions from the scheme members themselves and also from their employers, and also from the returns that we can get from investing these contributions in advance of them being needed to pay people's pensions and other benefits. Member contribution levels are set nationally and contribution levels for scheme employers are set locally. So effectively, the risk of investment underperformance is borne by scheme employers. Every 3 years, our actuary, Barnett Waddingham, set contribution rates for our employers based on assumptions about the assets and liabilities of the fund, but also in terms of expected investment returns. Moving on to the the executive summary. Following results of the last triennial actuarial valuation, as at March 2019, we have engaged investment consultants Mercer to review the pension fund's current investment strategy and strategic asset allocation.
Sorry, David, can I just, Felicity Rice, Councillor Felicity Rice says, if I said it wrongly, I apologise. She's questioning whether we're on item 6 or item 7. We did item 6 because there were no urgent items, and we are now on item 7. Apologies for interruption, Chair.
Thank you, Peter.
Thank you. Mercer's concluded that the discount rate used by the actuary, or the target investment return rate of 5%, would be or will be challenging to achieve with the current target asset allocation the fund has, given the outlook for markets. Mercer have therefore recommended making some changes to the strategic asset allocation in order to improve the chances of achieving this target rate of return without unduly increasing risk. Members of the committee had a training session with Mercer yesterday, where Mercer went through their reports and their recommended changes and the reasons for those recommended changes. These the main changes are summarised in the executive summary. So, an increase in our overall equity exposure from 45% to 50% of our total assets. Within that equities allocation, to reduce the proportion of UK-specific equity holdings and to increase the proportion of actively managed equity holdings and therefore reduce the proportion of passively managed equity holdings. Outside of equities, the main change is to, or proposed change is to reduce the allocation to corporate bonds. In addition to reviewing the strategic asset allocation, we also asked Mercer to consider options to enable the pension fund to move towards a low carbon future. As part of their work, Mercer looked at two potential approaches: disinvestment and decarbonisation. In summary, disinvestment requires completely divesting from those companies involved in the sourcing and refining of fossil fuels, whereas decarbonisation means a reduction in allocations to those companies which are high carbon emitters. And therefore, it looks to not only influence or look at those companies involved in the supply of fossil fuels, but also companies involved in the financing of fossil fuels, such as banks and other financial institutions, and also those companies that drive the demand for the use of fossil fuels. And again, Mercer talked about this in some detail at the training session yesterday, the two different approaches, and those are detailed in the report and the appendix. Of those two approaches, Mercer's favoured option is decarbonisation, as opposed to a blanket divestment from all fossil fuel companies. Their analysis, which is in the report and in their report as an appendix, shows that decarbonisation can deliver significantly greater reductions in the carbon footprint of investments. It also allows for continued influence with companies and is, from a practical perspective, is more straightforward to implement and less costly to implement and less costly to manage. That's all I wanted to say, Chairman, at this point.
Thank you very much. Yes, I think we learned from the whole process that there's a number of significant changes that we need to make. As David has hinted at, we need to have a more global approach. We need to look at increasing investments in small cap equities and emerging markets equities. And we need to be switching from passive funds into more active funds. And I think all the reasons went into the details of that. Also, we're making a significant investment in the new global sustainable fund that Brunel will be launching towards the end of this month, by putting 20% of our equity portfolio into that fund, which will make a major effect on decarbonising our investments, with potentially up to 2/3 of the carbon footprint being reduced by investing in their sustainable fund. So it's a very significant change. I think what I'd like to do is ask Alan to make any comments that he feels as our independent advisor, and then open up the whole thing for debate. So Alan, you first.
Thank you, Chairman. Well, this has been the result of a lot of iteration between Mercer's, yourself, David Wilkes, and myself as the independent advisor. I think we've come up with a good, balanced strategy. We will fall short of the 5% target, but as we've discussed in training, that is pretty ambitious target, and it relies upon some what we think are excessively optimistic projections from the actuary on returns from equities and property. So we have to aim off from that and accept a more realistic view. So we hope to deliver something like a 4.2% return by taking slightly more risk, by going back into equities, but globalizing the portfolio and hedging back a lot of the currency risk to sterling. And within the new global equity portfolio, as you said, we're making our first involvement into a pure sustainable equities portfolio, which is will be a new departure for us, and that will be a quarter of our global equity commitment. So quite a big effort at this stage, and we may well be able to increase that as we gain more experience of the success of that fund. Elsewhere, we're stabilizing the property portfolio. We are a little more concerned now about the risks in property, and we may want to recalibrate some of the elements within the property portfolio, but to reassure councillors, we are pretty underweight in retail, which has been badly affected, but we do have something of an exposure to the hospitality sector, which we need to monitor carefully. And our inflation hedging LDI portfolio, we're going to stabilize that. We're hedging out 30% of our inflation risk. We think that's a fair balance, but there are risks there, obviously, as we know, associated with the government's renewed attempt to maybe switch from RPI to CPI, but that's for later in the discussion. But I think in summary, I'm very comfortable. I support the Mercer recommendation. We've had a lot of input ourselves, and we've aimed off from some of their early recommendations. And I think it looks a pretty good outcome. Thank you.
Thank you, Alan. I think what is stressed, this is not the end of the story, but a work in progress. We are gradually moving assets from the UK to the global approach, but we're still retaining a higher UK percentage than most certainly indicated to start with. We're also starting the process of investing in sustainable funds, and there's certainly no reason to believe that this is the end of the process, but we will increase our investments further over time as we get more familiar with the investments and get more comfortable with the performance and track record that the new fund will hopefully show. Right, over to you guys now. So Howard, you've indicated first, so if you want to ask a question or...
Yeah, well, no, I've got an opinion I have.
Yeah.
Following the Mercer recommendations, I fully agree that we ought to be transferring the emphasis from United Kingdom investments more globally. And I think they put up a good argument for that, and one of which I've always thought myself. So I'm happy to go along with that one. I'm also happy with their argument and reasons for going more into equities. I think that's very good. And I go along with that. But what I am not happy with is the idea that we should go more active and less passive. In their recommendations, which is quite substantial, they don't actually give us any reason why we should do that. And I've asked for information about our record, that is the Dorset Council pension record over the last few years, and I haven't received it yet, as to how our investments in the past have proceeded as active versus passive. And we haven't had that information. The only information we've got, which is indicative but doesn't go back long enough, is Brunel. But on page 77 of our agenda, it refers to Brunel's record. And when you look on there, every single one, I think, of their active investments is down on the standard that they should be receiving. Every single one is negative. When it comes to their passive investments, and this is only over the last months or years, so it doesn't really go back far enough for making a final judgment, but their passive ones are all near enough dead on target. So what evidence we have shows that the passive ones are better than the active ones. And so therefore I do not agree with this recommendation about taking on the more active investments. I might agree if they came up with some evidence to support it, but there is none at all. So my suggestion is that for now, we don't do that one. We stay as we are with the ratio of passive investments until we get some evidence to show that the active ones are better.
Okay. Alan, did you want to make any comments on that?
Well, I can attempt it. I mean, it's a fair challenge, and I think we have to accept that. It will be the case that still 30% of our equity exposure will be passive. So we're not giving up on passive at all. And that includes the smart beta, which is essentially a passive product. In terms of our existing managers, before we moved across, we have two managers who've done very well for us in equities. Schroders, who run our UK small cap, have an outstanding performance, consistent of our performance. And Wellington, our last remaining global manager, has outperformed by 1.5% per annum since the inception of the account, which was the target they were set. Because we have this high discount rate of 5%, we need to squeeze as much of the portfolio out of the portfolio as we can. And we hope that active managers will add some, what we call alpha, an outperformance of 0.5% to 1% against the benchmark. To be fair to Brunel, as I recall, their global high alpha product, which we invested in, has outperformed since we started investing. So far, I think they've done okay. There's a slight lag on the UK active, but I think we have to accept the challenge, but we do need those extra returns. And I think the balance of 70 active, 30% passive is not a bad starting point.
Okay. David, did you want to add anything?
Yes, thank you, Chair. I understand the concerns of Councillor Legg, and I think that if we were proposing that we were moving from a global passive and a UK passive approach to a core global active, I probably would not have been. I would not have been supportive of this change. I think what we are trying to do is target those, in terms of our active mandates, is target those areas where active managers can add value. So the things like emerging markets, smaller companies, the high alpha end of things, and the sustainable equities as well. I think those are areas where active managers can add value. If you're just looking at core global, that it's very hard to beat the market over the longer term. So that's one of the reasons why initially we had an allocation to global core active, which we've moved away from that. We've said no, we don't need that. We don't think that adds anything that we can't get from a passive solution. So yes, the headline, kind of seems a bit contradictory, moving from passive to active, but I think we're doing it in a targeted way. In terms of the performance of the Brunel funds, those funds that are, Alan's given some commentary on that. Clearly, they have got, it's not long since they've been inception. Also, a number of the funds that we're looking to, or portfolios with Brunel we're looking to allocate to, don't have a track record as yet. So the sustainable equities one, we don't know how that's going to perform. The smaller companies one is just being launched as well. So some of the funds that the portfolios we're looking to invest in don't have a track record, and those that do have a very short track record. Okay. Thank you, Chair.
Thank you. On to Councillor Wharf next.
My hand has been up much longer.
Sorry?
My hand has been up much longer than Peter's.
I'm not sure it has, but I defer to you, Councillor Roberts.
Yes, sure. Sorry if I missed you. Mark, do you want to? You're on mute, Mark.
Apologies. Two parts. One, a partial response to Councillor Legg. It was explained by Mercer that an active management can more easily fulfil our low carbon desire than a passive trust, and I think that's quite important as we move further down that road. But my main question is, how many of the 10 Brunel partner organisations use the same actuary as us And does that put us at a disadvantage if the others are using the other two actuaries who are looking at more like a 4% or a 3.8% discount?
Who wants to answer that one? Alan or David?
I can attempt.
I think
Oh, sorry.
I'll go first. I think it's fairly well split between the big three players. So, you know, so the range of discount rates will be between 4 and 5% approximately. And the higher the discount rate, the more that encourages you to take active risk by having a higher equity allocation or to go for active managers.
Okay, David?
I think the only thing I just wanted to add is just the comments I made, if you like, in terms of context. So if we did have a lower discount rate, if actually Barnett Waddingham, or we had a different actuary that come up with a lower discount rate at the valuation last year, we would have been going out to scheme employers and saying, I'm sorry, but we need to up your contributions. So having a different actuary would have implications, but I think that the principle still remains the same, that if in order to pay the benefits to our members, either our investments need to, if our, you know, every pound generated by our investments is a pound less that our employers need to contribute.
Yeah,
I don't know if that helps, Councillor Roberts.
Thank you. It does explain it to a degree. Yes.
good. Thank you. Councillor Wolf.
Thank you, Chairman. First of all, thank you to Alan, who I think cogently explained why we should probably follow this strategy. Although I entirely understand Councillor Legg's question, because I don't think it was particularly well explained, and I think it assumed a fairly high degree of previous knowledge. I mean, at the risk of being very basic, our responsibility is to our investors and to our pensioners, so we have to make sure that they get as good a return as we can probably give them while securing the future of the pension fund. And we must never forget that. And when we look at climate change and other issues, it is not that they're mutually exclusive, but there is tension between them. So we have to try and recognise that there is some tension between the desire to achieve climate change and the desire to make sure that we get maximum returns for our pensioners' investors. And I think the active responsibility, or the active mechanism, is the only one that we can use if we are going to make progress on decarbonisation, whilst making sure that we provide the correct degree of returns. So yes, I'm in favour of it. And the one thing I'm not in favour of is just leaving it to the market forever, because there'll be no point in having a pensions committee or Brunel if we did that. Thank you, Chairman.
Okay, thank you. Councillor Rice.
Thank you. Yeah, I would just like to highlight that Councillor Worf said before that there is a tension between doing investment that benefits climate change and getting a return. From all of the information that I've been provided, actually the two go hand in hand, but we do need to be thinking about it very seriously and make sure that we choose the correct investments, but it's certainly not mutually exclusive. And I just wanted to point out that that I generally am more in favour of actually keeping investment not only within the UK but within Dorset. So, for example, having a hotel that we own in Poole or Dorchester, our own residents are working in the hotel and making sure that it thrives, and other residents are able to stay there, is quite different to owning a hotel in China, for example, or even just in London. And the benefits of investing in the very people that are contributing to the pension fund, I think is something that we should take seriously and sort of look to develop a policy going forwards in that area, rather than simply saying we shouldn't invest in our own people.
Okay. Alan, did you want to comment on that at all?
Well, we've got a £3 billion portfolio. So the problem, Brunel answered this at the last meeting we had in February. It's very hard to get the scale if you invest locally, and also, of course, you're subject to all sorts of potential conflict of interest, I think. So in terms of our ultimate responsibility to deliver pensions, that sounds attractive, but I think it wouldn't really provide a practical solution to the problem that you as a committee face.
Thank you.
Would I be able to come back on that?
Yes,
Okay.
yes.
I suppose renewable energy would be one of the obvious ones for me. So I'm not suggesting that we would be looking at the whole £3 billion, but maybe 1% of the fund, something like that, that is investing in renewable energy within Dorset, which provides energy to our own residents and own pension contributors, and provides a good, reliable return.
I think
that could come through our infrastructure investments. There's no reason why. If the right opportunity came along, our two infrastructure managers couldn't seize that. I quite support that.
Yeah, you're right. I think the best approach is via infrastructure and investing directly or in partnership with others. But certainly it's something we can be happy to look at in the future. Councillor Legg.
Yes, I'd like to put a proposal, if I may, which is that the Mercer report, or reports, because there's several things in there of changing of our investment policy, are agreed to, except where it involves active management taking over from passive managed investments, that is held off until our next meeting. And by that time, I want some evidence, please, to show that historically there is evidence to support that move. That is, I'd like some facts and figures of what's happened in the past, and we haven't got any. So I propose that we accept all the Mercers except to hold off that passive to active suggestion until the next meeting, and evidence is supported.
Okay. Is there anybody who wants to second that? Doesn't look like it. So, Councillor Rice?
I'm happy to second it, but just the bit about the additional work rather than accept the rest of the report, because I have some other comments on the rest of the report.
Okay. Well, do you want to make? We'll come back to you in a minute, then, Howard. But do you want to make your suggestions about the other parts of the report? Councillor Rice? You're
Sorry,
on mute.
just going through between different screens and then trying to come back for the mute button. Yes, so I would like to propose regarding specifically more around the fossil fuel investment sort of and diversification aspects. So do you want me to put those proposals forward now, or do you want to deal with?
Okay, well, yeah, maybe we should deal with Howard's motion first and then come back to any other elements. So, Howard, you're specifically proposing that we remove the references to the switch from passive to active, to wait for more information to be discussed at our next meeting, but all the other applications should go ahead. And Councillor Rice has supported that. Does anybody else want to make any comments on that specific proposal?
Can I just come in? Whilst we're waiting for Councillor Rice to come up with her amendments, then the only one I would put forward is that the passive to active suggestions are withheld until the next meeting, and we have evidence to support it then, because I think Councillor Rice might be suggesting something else which I might agree with.
Yeah.
So just that one thing about active and passive not going ahead yet.
Yeah. Okay. Alan or David, do you want to comment on that?
It would complicate matters, but it's up to the committee, of course. I would not personally support the recommendation. I think what we've got from Mercer's is a good balance, and we're retaining a 30% passive exposure.
I don't have anything to add to Alan's comments, Chairman.
Okay. Does anybody else wish to make any comments on that, on Howard's proposal? Councillor Roberts.
Yes, I would like a counter proposal that we accept the report in full now.
Okay, well, I think at this stage we can we have time to deal with any other amendments as well. So, does anybody else wish to speak specifically on Howard's proposal? Councillor Brown.
Yes, thank you, Chair. Yeah, I think Howard's proposal is an interesting one because it is quite a significant move, isn't it, to change our emphasis to the actively managed sort of equity holdings. And I tend to agree with him. You know, we need to. It needs to be a bit more of an evidence-based decision, that we are persuaded on the basis of hard facts and evidence that actually that will be a good decision. Not that, you know, there's a significant sum. So I suppose I tend to have a sense that actually it probably is a decent move, and it will help. But yeah, I'd like a bit more of an evidence base to feel sort of secure in that significant decision. So I think I'll back Howard's proposal.
Okay.
Can I just interject? Apologies,
yeah.
But I think our current passive exposure is roughly 40% of our equity exposure, and the proposal is to reduce it to 30%. So it's not a major move, and it does facilitate us being able to increase our exposure to areas like small cap, where you really need to have and sustainable equities, where, you know, as we've demonstrated, I hope, active management is the preferred route. So I think it's more of a marginal move than perhaps Councillor Legg is fearing.
Okay, back to you, Howard.
I'm not specifying whether it's small cap or not. I just want passive management on it for now. Remember, I'm not saying I'm against it in all. I'm just saying there's no evidence to support it at the moment. And I've asked for evidence and haven't had it yet. And therefore, I want to delay this decision until the next meeting, just to review how the past record has gone between these different types of funds.
Okay. Anybody else? Okay. Well, I think that's a fairly clear proposal. And a bit of advice on this is how to actually do the vote, because I certainly can't see everybody up on my screen.
Chairman and Vice Chairman here, I suggest you go through each member in turn and ask them to state clearly whether they're for the proposal or against the proposal.
Okay. That makes sense. Can we find a list of we all are alphabetically? Right. Okay. Start.
Unknown participant is now exiting.
Chairman, would it be better if David took the count because you have a vote?
I'm happy. Oh, it looks as though we've got an issue with with Councillor Canning's technology again. So if I go through the names and it may not be in alphabetical order, it may be in the order that I can see you on the screen. So if I miss anyone, please shout. So starting in my top corner.
Sorry, David, I'm concerned that if Andy Canning drops out for just a minute or two, it will affect the overall democracy and governance, irrespective of which way he votes. Can you just give him a minute before you take the vote? Because I have no idea which way he's going to vote, but I just think it feels wrong.
Okay. Do we want to proceed with any other? Did you want to take over as chairing, Councillor Worth, and see if there's any other questions on the? And I know Councillor Rice has got another proposal that she would like to make as well. So
can I just
see if there's any more questions?
I would prefer that we wait until he's able to come back, because it's my experience in other meetings is that if you haven't been able to listen to the whole conversation, there's definitely a preference to just hold on a couple of minutes so that everybody's involved.
As Vice Chair, Acting Chair, I support that. Irrespective of my own views, I'd like us to make every effort. Does somebody have his mobile phone number?
Vice Acting Chairman, have we got time to make a cup of coffee then?
I think we have, if everybody's comfortable about that. Can I say that I now make the time 10:45? Can we stay online, but can we restart at 10:50? David, can you try and get hold of Andy? Is that okay, everybody? I've got thumbs up from everybody, so we'll reconvene at 10:50. Thank you.
Unknown participant is now joining.
Hello.
Oh, hi, Anne. Hi, Councillor
Hi.
Canning.
Sorry.
We've just the vice chairman.
Or against. 4 is that they are voting in favour of the proposal put forward by Councillor Howard Legg. Against is that they're against it. Over to you, David Wilkes.
Thank you, Acting Chair. Councillor Legg.
For.
Councillor Wolf.
Against.
Councillor Roberts.
Against.
Councillor Canning.
Against.
Councillor Bryan.
Against.
Councillor Brown.
4.
Councillor Rice,
4.
Adrian Felgate,
Against.
Councillor Beasley.
Against.
So
that is the vote. I make that 6 votes to 3 against. Is that correct?
that's correct.
Fine. Members, can I suggest as a matter of course that we should move towards a proposal to accept it or further amendments? If there are no further amendments.
Yeah, I've already requested a further amendment.
Thank you, Councillor Rice. Would you like to just in one sentence specify your suggested amendment so that we can both propose it, second it, then have a debate if we need to, and then vote on it? Over to you.
Well, do I have permission to give a little bit of background to the proposal?
Yes, you do.
Thank you. Okay, so over the last 2 years, after almost 3 years of rising oil prices, the oil and gas sector placed dead last in the S&P 500. This follows a 10-year trend of lagging in the market. The industry's fall has been long in the making. In 1980, the industry claimed 29% of the S&P 500. Today, it only occupies 5.3%. Sorry, that was a year ago, the lowest level in 40 years. During the latter part of the last 30 years, the sector remained an important component of fund portfolios, even as market support for the industry eroded. It was acknowledged yesterday in our discussions with Mercer and Brunel that we have reached peak fossil fuel sometime within the last year. This is vital to acknowledge, since we are now in full force of an energy transition from fossil fuels to renewable energy. The financial risk of staying with fossil fuel and related companies is enormous and risky, and very important for us to take into consideration. For investment advisors and fiduciaries that continue to hold oil and gas stocks, it is a much smaller task now to reallocate 5% of an investment portfolio than previously when it was 29%, for example. It also becomes much less painful when the poor sector performance is acknowledged. The sector has underperformed in the stock market for a decade and continues to perform poorly and offers little in terms of value proposition going forwards. Finding alternatives to fossil fuel companies will not be difficult. Every other sector in the economy is growing faster, smarter, and healthier. This comes directly from Tom Santillo, who previously managed a $156 billion pension fund. And so this recommendation comes from somebody with extreme financial experience. I propose that we ask for a second assessment, an independent assessment, to provide us with 1, a fossil-free portfolio proposal that meets investment targets, and 2, a time frame in which they can achieve the portfolio changes, and a second proposal that we ask Brunel to list the organisations that are on the global coal exit list that we have investments in, and that we are divested from these organisations within 18 months if the companies have not already divested themselves. Thank you.
Thank you. Councillor Rice, can I just establish that you're happy that both of your proposals were taken as one?
The second one regarding the global coal exit list is a relatively simple thing, so I think it would be better if they could be done separately. Okay, if that's your wish. This will take a little time, members, so I'm looking for you to be brief. Councillor Rice has summed up her proposal, I think, adequately for people to understand what it is. Before I go to Alan Saunders to get advice as to using our official advisor, Councillor Howard Legg, are you seconding that? And if you are, can you try and restrict yourself to as few words as possible, please? You're on mute, Councillor Legg.
Thank you. No, I'm not seconding it at this stage because the second one I wanted to actually object to. So no, I just wanted to speak to them in a minute.
Okay, can I take Councillor Rice's first proposal? Can I ask for a seconder to her first proposal? Councillor, I've got Councillor David Brown. David Brown, I think your hand up went up first. Are you seconding it?
Yeah, I'm happy to second that proposal.
Thank you very much. Councillor Howard Legg, did you want to speak on it? Because I'm going to come back to you because we've had a proposal in a seconder. I'm going to get our pensions advisor to comment and then I'll come back to you to speak.
No, I was just offering to second that first motion.
Okay, fine. I'm going to take both your hands down for the moment and I'm going to ask Alan Saunders to comment from a pension advisor's perspective.
Well, the investment case was put forward by Mercer's yesterday and is very much supported by Brunel, that we should pursue a decarbonisation route rather than a disinvestment route. So that's, if you like, the basic strategy that we're putting forward. Councillor Rice makes some fair points about the investment risk with oil and gas. This is known as the stranded assets theory. It's been around for some time now. We, of course, are accommodating that, which by moving towards a more global portfolio where energy is very much smaller. As we know, in the UK, energy and resources are a large constituent of the FTSE 100. So we're sort of assisting that decarbonisation route just by going global. We also have active managers who will be avoiding areas like oil and gas if they think they are bad investment propositions. And that's always been the case, of course. And of course, we're moving into sustainable equities, which will also be probably aiming off from high dependence on oil and gas. I think, you know, we are accommodating Councillor Rice's broad requirements, but in a sort of a way that meets our investment obligations, which are better delivered through a decarbonisation route, which has a much lower carbon intensity, to remind councillors, than going down a straight disinvestment route. And that was demonstrated yesterday by Mercer's with their ratios.
Thank you very much. I have Councillor Andy Canning, followed by Councillor Mark Roberts. Councillor Andy Canning.
Yes, I'm hugely sympathetic with what Councillor Rice is proposing, and very supportive of the general move that we have to deal seriously with the environmental problems and actually make sure we make a significant impact in reducing our carbon footprint. But I don't actually think the proposals to divest from fossil fuel companies completely is actually the best way forward. I actually think the combination of going down the route of investing in the Sustainable Equities Fund is something like a 2/3 reduction in the carbon footprint compared to the market as a whole, and with all the other active funds that Brunel manages also committed to a 7% year-on-year reduction in their carbon footprint. The combination of those two things actually means we are being more environmental than the proposals that Councillor Rice is looking to support. It may not produce the same dramatic headlines, I do accept that, but I think actually the proposal as on paper is actually better for the environment and better in tackling our carbon footprint than what is being proposed in this amendment. So I won't be supporting the amendment.
Thank you, Councillor Canning. Councillor Mark Roberts.
Yes, very similar lines to the chairman's. The figures prepared by Mercer, I thought, were absolutely fascinating. That a 19% reduction in the carbon footprint by divesting from fossil fuels, but a 64% reduction in carbon footprint by following the low carbon over the same period, I thought was compelling. And also, I understand that our investment in companies that may have a partial fossil fuel sector is 7% of our pension fund. So it is not as major as some funds. And we have already, I know we have not invested in companies that we feel are inappropriate, like Exxon, but companies like Shell, where one of the biggest investors now in green energy, it may be unwise to just use a blunt instrument and not to support their investment in green energy and renewables. So I cannot support this motion.
Okay, thank you very much. I'm looking to move this on. So I'm looking, does any, Councillor Bryan, or is that Councillor Brown? I'm not quite sure. It's both of you, I think. Can I take Councillor Bryan first, because he was first? Councillor Ray Bryan. You are on mute.
Thank you, Chairman. Obviously, part of me is very supportive of what Councillor Rice is trying to say. My concern is that if we overnight took the investment away from these companies who are already investing billions of pounds in new technology to produce new fuels, I think that would have a detrimental effect on the aims that Councillor Rice and I both share. I part support what she's asking for, but I think it's a requirement that we do it in a gradual process rather than with a sharp knife.
Thank you, Councillor Brown. I've got Councillor David Brown, followed by Councillor John Beasley. Councillor David Brown.
Thank you, Chair. Yeah, I support the proposal mainly because the way it's sort of worded is asking for another sort of assessment to look at a fossil-free portfolio. I agree with the comments earlier that in the Mercer's report is quite compelling, you know, the sort of decarbonisation approach, looking at a 64% reduction in carbon footprint as opposed to divestment, you know, results in about 19%. So that's quite compelling. But personally, I don't see it as an either-or choice, really, that actually, you know, yes, we can follow a decarbonisation approach, and, you know, Brunel, you know, looking at the sustainable fund that Brunel are putting forward and the 7% year-on-year reductions is good. But can we do that and be fossil free too? You know, so there's certain investments actually which we, you know, and I think that's what this is getting at, looking at another assessment report to be able to make our portfolio fossil free. I don't see it's, oh, we do that or we do the decarbonisation approach. I think we do the decarbonisation approach, but we get this information to look at, can we make our portfolio fossil free, and do both of it really. So I don't believe it's an either or choice, and I think that's why I support this proposal.
Thank you, Councillor Brown. Councillor John Beasley.
Thank you, Chairman. Well, I don't support the proposal for many of the reasons we've heard from people who share that view. It, I think, came across very clearly yesterday from Mercer's regarding the decarbonisation route. A lot of work's gone into the preparation for this rebalancing, and over a fairly sustained period of time. I'm always nervous about making major policy decisions on the hoof, particularly when the amount of work and research that's gone into coming to a proposal has been such as this. We'll hear later on, Chairman, about how Brunel are proceeding down the decarbonisation route and the dangers of disinvestment as a blunt instrument to achieve an outcome. And when we hear about that, it will, I hope, reinforce why it is that we want to move so much into the Brunel Sustainability Fund, and how that will meet the objectives both of Councillor Rice and indeed, I suspect, all members of the committee. Thank you, Chairman.
Thank you very much. I have a request from Councillor Felicity. Okay, I'll take Alan Saunders, and then I'm going to Councillor Felicity Rice to sum up her proposal, and then I'm going to go to a vote because we do have a lot to cover today. So I ask everybody to be brief. Alan Saunders.
Just on this question of a second opinion, we have that already, don't we, with Brunel, who presented to us in February, and we'll be hearing again. I mean, Brunel are one of the leaders in this whole debate, the environmental debate, thanks to the Origins and the Environment Agency. But a third opinion is that of the Church of England through their pensions board, and I'm closely involved with that. And they also have come out very strongly through the Transition Pathways Initiative, which they share with the Environment Agency and others, that decarbonation is a much better route than divestment. Thank you, Chairman.
Thank you very much. I go to Councillor Felicity Rice to sum up. Just hang on a minute, please. I'm just trying to see whether somebody else has got their hand up. No, I've got something in the chat box which I can't quite see. Yeah, okay. Councillor Felicity Rice.
Yes. I'd just like to highlight a bit of confusion that seems to have occurred with the proposals. about it being just not making a decision on the hoof, or we can't decarbonise overnight. The proposal was merely for a second assessment that specialised in the benefits of decarbonisation as opposed to fossil fuel free divestments. And I agree with Councillor Brown in that it's not just I'm not saying that we need to divest everything, but we need to know where our investments are and understand exactly the impacts that they're having. So I feel that this decision is off the hoof in terms of like if we don't know where our investments are.
Councillor Rice, I think thank you. You've summed up absolutely adequately, and you're beginning to repeat arguments that we gave at first. Councillor Ray Bryan, you're typing. Is that because you want to come back in? Right. Okay. No, you don't want to come back in. I think we've had a good debate. I will now ask David Wilkes to go through the members, preferably in the same list you used last time, and they should either say for if they're voting for Councillor Rice's proposal or against if they're voting against it. David Wilkes, over to you.
There are two proposals.
Yeah, okay, sorry, they're voting for the first proposal only.
So the first proposal was for an independent assessment of a fossil free portfolio. Yeah. So Councillor Beasley.
Against.
Councillor Legg.
For.
Councillor Brown.
For.
Councillor Bryan.
Against.
Councillor Roberts.
Against.
Councillor Canning.
Against.
Councillor Rice.
For.
Councillor Wharf.
Against.
Adrian Felgate.
Against.
Okay, that proposal is lost by 6 votes to 3. We now move to the second of Councillor Rice's proposal. Could you, Councillor Rice, could you summarise it and may I press you to be reasonably quick in your summary? Over to you, Councillor Rice.
I appreciate that we have a time constraint, but obviously this is incredibly important. I propose that we ask Brunel to list the organisations that are on the global coal exit list that we have investments in, and that we are divested from these organisations within 18 months if the companies themselves have not already divested. These are the worst companies in terms of causing air pollution, damage to human health and climate change. And at the very, very minimum, these are the ones that we want to be divesting from.
Thank you very much, Councillor Rice. Do I have a seconder for that proposal? Councillor David Brown.
Yes, I'm happy to second that proposal.
Right, the proposal is now open for debate. Councillor David Brown, is yours a legacy hand or do you wish to come back in? Okay, Councillor Bryan.
Yes, thank you, Chairman. When Councillor Rice started, I was minded to agree with her in full. The difficulty I have is that if we go with the motion, we're making a decision to divest ourselves from these companies without having a reverse that could say if they were moving towards carbon neutral over a period of time, we should be staying with them. I'm perfectly happy for us to get a list because I think that's important that we know where our money is going. But I can't at this time support that we have a motion which says we're out in 18 months.
Thank you. Councillor Mark Roberts.
Yes, thank you, Chair. Ray has pretty well stated exactly what I would be very happy to see that list and to see what involvement we had with those companies, but not put a time limit on it.
Okay, I'm going to ask Alan Saunders to give his professional opinion in a minute if there are no other members wishing to contribute. Alan Saunders, please. Alan, I'll come back to you. Councillor John Beasley, you put your hand up.
You're on mute, Alan.
Thank you very much. My point was really that if this issue is so incredibly important, I'm very surprised that neither I nor Brunel have been approached on this specific question previously. And I think that if we had been, as the representative of Dorset on Brunel, certainly our chief stakeholder officer, James Russell Stracey, who we'll hear from later on anyway, would have wanted to facilitate a specific answer to it. The sustainability credentials of Brunel are second to none amongst the pools, and I'm sure that there is a response which would satisfy Councillor Rice and the members of this committee, no doubt about it. And I'm always happy, as you know, to represent Dorset at Brunel, both inside and outside of meetings in the most appropriate way. However, I do need a bit of notice in which to do it.
Thank you very much, Councillor John Beasley. Councillor Howard Legg.
Yes, I'm happy in favour of the list part of it. And in fact, I think that's essential. We ought to have that. Information is always a good thing to have as a background. I'm not so happy about the divesting. It was because of this argument we actually heard yesterday, but I've heard before, that when you divest from an organisation, you lose control or any control over that organisation. And you don't know what they're going to do with their own policies after that, or you don't have any say in them. But also, they can actually sell assets, and you don't know who the assets are being sold to. And if, for example, there are oil fields or gas fields being sold to companies or countries such as Russia or Brazil or India or China, then you can bet your bottom dollar they're probably buying them in order to be able to exploit them. So I'm not overly keen on divesting. I think I prefer to keep some form of control. And therefore, whilst I agree with getting the list of these companies, I don't agree with divesting. Thank you.
Thank you very much. Alan Saunders, can you come back now? Can you come in now, Alan Saunders?
Yes. Well, this is not a material fact in terms of the investment consequences, unlike the previous debate we had. I would like more input from Brunel, quite frankly, on this. Councillor Beasley got it spot on. They are leaders and they will have a view on this. And it was briefly discussed yesterday. Before we commit to any such resolution, in principle, I think we would be sympathetic. But I'd like to work with Brunel and through them to our underlying managers to get a better insight.
Thank you. Councillor Rice, would you like to come back? And if so, can I ask you to do it briefly, please? Thank you. You're on mute.
Yes, so maybe given that feedback, maybe if we remove the timescale to the proposal and simply ask for the information whether any of our investments are on the global coal exit list, there seems to be general support for that. I agree, Councillor Beasley, that Brunel have done some really excellent work, but I also know that they do need support from us to move as fast as they need to. They're working with an awful lot of different investors that are not used to the change that is required. So I think they're fully supportive of our efforts here.
So can I establish, are you changing your proposal now?
Yep. So the proposal now reads, I propose that we ask Brunel to list the organisations that are on the global coal exit list that we have investments in.
Members, I don't want to go to a vote if we're all broadly in agreement that we should be able to review that list. Can anybody who is against please put their hand up or speak? In that case, I do not see the need to go to a vote if we are, by means of this meeting, asking Brunel to provide that list so that we can use it along with everything else in our deliberations. Is everybody happy about that? If anybody's unhappy, I need you to show. Right, Councillor Rice, are you comfortable with that outcome?
Thank you.
Okay. In that case, we will not take a vote because we are agreed and we've got a way forward and we've all agreed it and there's been no person against it. Can I go back to the item, which is the review of the investment strategy? Can I ask that somebody proposes we accept that? Councillor Mark Roberts?
I have already proposed that.
Yeah, I know you did, but we said go back and we'll take the amendment.
I re-propose.
Okay, I'm just for the point of process. Councillor John Beasley, are you seconding it, or do you want to
I'm
make
very
a
happy
comment?
to second that.
Happy to second. I think largely we've had a very long and
Unknown participant is now exiting.
I don't know who's exiting, but they're unknown. Does anybody want to speak on the proposal before I go to a vote? I am going to, Councillor Beasley, your hand is still up. Is that a legacy hand? Yes, it obviously is.
It's been removed, Chairman.
Thank you. Can I find out, because I'm assuming that we would all therefore be in favour of this proposal, which has been proposed and seconded, and rather than take a vote, is there anybody who wishes to vote against or abstain? Please make yourself known now.
I shall abstain.
Okay, in that case, because I'm not clear, David Wilkes, can I ask you to take a vote? And if the vote is either for the investment strategy, against the investment strategy, or abstain, please ask the names in your usual way.
Thank you, Vice Chair. Councillor Beasley.
For.
Councillor Legg is abstain.
Abstain.
Councillor Brown.
Yeah, I'll abstain.
Councillor Bryan.
For.
Councillor Roberts.
Unknown
For.
participant is now joining.
Councillor Canning. Councillor Canning seems to have dipped out a bit.
Andy, you're back
Yeah,
again.
sorry, I lost the signal on the phone again. What are we voting on?
We're now voting on the review of the investment strategy. For, against, or abstain.
For.
Thank you.
Councillor Rice.
Abstain.
Councillor Wolf.
For.
Adrian Felgate.
For.
I think that's 6 for and 3 abstain.
It is by my calculation. Thank you very much. You members for that. Can we move to item 8, which is investment pooling update?
Apologies, Vice Chairman. I just want to be clear that includes the authorising officers to implement the changes to the strategy.
I don't think there's any doubt that the investment strategy includes that proposal.
Thank you for clarifying.
I'm not going to go back and have the debate again.
Thank you.
Thank you. So we're moving on to item 8, investment pooling update, to receive an oral update on partnership governance and other matters from the CEO and the Chief Stakeholder Officer of Brunel. Would you guys like to introduce yourself, and would you like to lay out what you're going to say, how you're going to say it, and how we should interact if we should?
Fantastic. Okay, well, thank you, Councillor Wolf. Wasn't how we intended to present you guys in this new world. I did want to be there in person very much to meet you. You know, I've been in the role now since January this year, so 3 months in the office.
Laura, forgive me, just for the members of the public, can you just absolutely confirm your name and your role and your organisation, please?
So, Laura Chappell, CEO of the Brunel Pension Partnership. I'm also accompanied by James Russell Stracey, who is the Chief Stakeholder Officer of Brunel too, and he'll be presenting as well.
Thank you very much, Laura, and sorry to disturb you, but Councillor Andy Canning has got his hand up, and I feel certain he wouldn't have done it unless he wanted to raise something right at the beginning. Councillor Canning.
Sorry, that's not right. I'm afraid I'm having lots of technical problems still, and just trying to make the damn thing work.
Okay. Sorry, Laura, I'm sorry to disturb you.
That's all right.
Sorry.
Okay, thank you, Councillor Wolf. So first off, I think I wanted to say thank you, a big thank you actually, to Councillor Beasley, Dave and Aidan, who have been massive supporters of Brunel, and particularly for me during my CEO internship. into the company. So I don't think we could do the job without support of you guys. And it's really heartening for me today to hear the conversations that you've been having and the direction that you're moving into on the low carbon transition sustainability angle. So, so thank you for inviting me along. I do really appreciate it. I think the debate is really interesting, and I do absolutely think that you guys are heading in the right direction. So very supportive of that. So I'm just going to do a little bit today on Brunel, what's happening with us. We will talk a little bit about responsible investing, but I'm not going to go over all the ground that you went over yesterday and today. But what I will say is that we will support your position. And I'll tell you a little bit about why we support that and the activities that we're doing to make it that way for you. So we have got a slide deck. I don't know if you've got access to that. Have you got it in your pack? Dave, did you circulate?
Dave, can you share it?
I have circulated it, but I'll see if I can share it.
Fabulous. Okay, that would be really good. I'm not going to spend a huge amount of time on it because I know you are short of time and you just need a good, robust update from us. So Brunel is 3 years old now. So we were formed officially in July 2017, and we've been going for 3 years. And we've been managing investments now for roughly about 1.5 years of that time. And obviously, we've got quite a long transition pathway to complete all of that. So, so I'm on to the third slide in the deck. Dave, if you're able to do that, fantastic. Good. I'm keeping up with you. So we have to date, we've successfully transitioned nearly half of our listed assets. And we've got another tranche coming up fairly soon in the next 2 months, which will take us to a good number. And then the last piece of the jigsaw puzzle we'll be doing will be the our fixed income bond funds later on in this year, and launching the tenders for those. So we had great commitments to cycle 2 of our private markets, in fact, more so than we thought we were going to get. So it was very encouraging. And we've just started to deploy some of that capital now. I just heard yesterday about some more investments that we're doing. So that's really pleasing that there are good opportunities there to do that. Our property assets under management are now at 1 billion, and they're still growing as we move over the legacy. And we've just started the manager searches and selection for the sterling corporate bonds and the multi-asset credit funds. And as you heard this morning, we've just started opening up the sustainable equities fund and doing the transition into that as well. So that's another great alternative to move into. So where we are at the moment, you know, we've worked through COVID. Actually, from our perspective, nothing has really changed. The markets are very, very volatile. Well, they have been very, very volatile. They're starting to settle a little bit more now. But you will have seen the investments that we've got go up and down and through the roof. But we are long-term, we're sustainable. We're looking at performance over a 3 to 5 year minimum. So something like this shouldn't disturb us. And we should be able to hold our line on an investment perspective and still get the outcomes that we need. And I'm really pleased to say, actually, that all the funds we've got at the moment that are live are working to the outcome that we set out for them right at the very beginning. And that's a really positive for us and something really great to take away. So I've just looked at this quarter's performance, and that's looking very good from our perspective. So I'm really pleased about where we're heading. I don't think we could have had a better weather the storm that we've had over the last few months. So I think that's that one. Dave, could you move on to the next slide? Thank you. So just talking about what we've got coming up, we've just launched the Diversifying Returns Fund. We've got global sustainable equities coming up pretty soon, smaller companies as well. And then we're on to the bond fund, so sterling corporate bond, multi-asset credit. And then later on next year, we'll be looking at global core, which actually means pretty much we'll be all done with the transition by 2021. And that then leads me on to what we're going to be doing next for you, because actually we've got a jam-packed agenda in terms of making our funds more sustainable and that path to a low carbon economy. So Dave, can you move on to the next slide? Oops. Oh, now I seem to have lost that from my PC. So I'm going to keep going anyway.
Laura, on the screen that I can see, we've got something headed Dorset Holdings. Is that what you want?
Fantastic. It's up now. That's fine. I just wanted to remind myself of what you guys are actually invested in and what it's been doing since inception and over the last 3 months. So that's just a highlight of where you are right now, and you can see your passive funds in there alongside the active funds that you've got. So all very relevant to your discussion. So Dave, can you just pop onto the next slide, because I'm not going to say too much about that, to be honest. Good news from your perspective. We were set up to do 2 things. First one is obviously to generate performance. Second one is to produce cost savings and to manage to the budget in the envelope that you've given us. And I'm pleased to be able to say that we are doing both despite COVID. So I'm really, really proud of the team here. I don't think they could have worked harder during this period. And I'm really pleased to be able to say that we are on track, which is a really great news story from pooling perspective. So that's all I'm going to say on that slide. So Dave, next, that's okay. Right, I'm going to hand over to James Russell-Stracey now, who's going to introduce himself and just talk very quickly about what we've done on recruiting a new Chief Investment Officer, because as you will all know, Mark Mansley resigned back in May, and we had to start the search pretty quickly to find a new one. So James, over to you.
Right. Many thanks, Laura, and thank you to the committee for inviting us along. It's the first time I've met virtually with people from Dorset, and it's been a fascinating sort of discussion. Just to help Dave in terms of the slides, I'll deal with this one first, then I'll come on to some others which are about myself as sort of Chief Stakeholder Officer. So as Laura mentioned, we've been looking for a new Chief Investment Officer. Delighted to say that we have found one. We have a candidate who has been through a pretty exhaustive process. He has met and been interviewed by members of the client group, and we're looking hopefully to introduce him to shareholders, oversight board members and the full client group very shortly. I think we may be able to announce a name within 24 hours, but we're delighted that we've found him. We were also extremely pleased, A, at the calibre of candidates that Brunel attracted, and B, that Brunel's position, Brunel's sort of role in responsible investment has allowed us to compete very effectively with city salaries. The candidate is going to be appointed on terms which are going to be well within the salary cap under the remuneration policy of Brunel. So it's excellent value for you as shareholders in Brunel. We've got an individual who is extremely committed to all the areas that have been discussed over the course of this meeting. So we look forward to being able to tell you his name very shortly, at which point, as I said, oversight board members and shareholders will have the chance to meet with him. And I can say it's a him, that's all I can say at the moment.
Great, thank you, James. Yeah, and all we can say right now that it is a he, and he is working in the city at the moment. So for us, it's a really great hire. And it also means that nothing changes from our investment approach. We just go on and develop what we've got, because he is fully bought into Brunel's sustainability agenda. So really great news for us. So good. Dave, next slide. So I think this is the one that you've all been wanting to talk about probably the most. And I'll reiterate what I said earlier, actually. It's been really helpful hearing your debate and your thinking processes around where you're moving to from a responsible investment perspective. I think there's a few things that we want to celebrate. So we were awarded Sustainable Investment Pension Fund of the Year this year, really pleased. We got a PRI appraisal rating of A+, which you'll see the scorecard down below. One of the things that we have been doing this year, and this is what makes it so tricky to tackle the disinvestment debate right now, is actually working out what a Paris-aligned portfolio actually looks like, because the industry doesn't know what a 0 degree portfolio actually looks like yet. We're having to do that work at the moment. And we are, at the moment, we're working with the Institutional Investor Group on climate change as one of the 5 European institutions who are testing pilot work for a Paris-aligned portfolio. So the work that we're actually doing now will inform that approach. And that's one of the reasons why we've said, I was really interested in your debate about when to disinvest, because we've set a kind of a target benchmark date for us to check in of 2022, when we will know what a Paris-aligned portfolio looks like. And at that point, if our engagement approach isn't working, we may well start to disinvest. And my own personal view is that in this post-COVID world, the debate on disinvestment is speeding up. It's not slowing down at all, and it will come along sooner rather than later, I think. The other points for me is if you want an organised transition to a low carbon economy, then disinvesting is really disruptive. And you might cover the environmental aspect of it, the E bit, but the S and the G, the social and the governance bit, then get thrown out of the window slightly. So for me, it's a very broad debate. It's not just black and white, in or out. Actually, there's so many other facets for that. And there's also a moral aspect to this for me, which no one ever talks about in the investment world. So I find it really interesting. And I really appreciate the approach that you're taking and the support that you're giving us on this. Because I think from my personal view, I can see that the world is speeding up. We are definitely having to speed up the work that we're doing, and we may well check in sooner than 2022. So to that end, we are running client workshops with all 10 of our partners in October to really just check in again and make sure that we're heading in the right direction. Because I really feel, I love the debate that you had this morning around impact investing. I think that's really important, and I think going forward there will be more local opportunities to do more impact investing. But again, they've got to make commercial sense to us, because at the end of the day we are here to generate performance, and that has to override absolutely everything else that we do. But if we can add some value in the community, in the local community as well, then it's a win-win for everybody. And I really believe that there will be more opportunities out there in the future, and we're working with the government at the moment to try and find some ways to more effectively do that with the large pots of money that we've got, so that we're not having to run individual tiny investments. So I really appreciate the discussion that you've had on that and the direction that you're heading. And I think these things are really important to discuss and debate and decide where we sit. So again, we'll be checking in with clients in October, working out how far we want to move along that impact investing spectrum, but whilst all the time maintaining our performance. So I think the other thing which was also really interesting for me this morning was talking about passive versus active debate. You know, and one of the problems with passive investing at the moment is that the indexes contain all the things that you don't want to be investing in. So we're working at the moment to try and pull together with a number of other participants some passive indices that will allow us to move more effectively towards more sustainable investing in the passive space. So I think that's really important to us, because we're here to give you choices. That's our job at the end of the day, is to increase the number of choices that you've got to enable you to do this. So I think that's very important for us. So thank you for including us. I will stop there, and maybe what we should do is just take questions on this aspect, and then I'll get James to introduce himself in the latter half of the meeting, if that's okay, rather than interrupting the flow.
Right, I will take questions, and I noticed Councillor Mark Roberts' hands up.
Thank you.
But I'll come to you in just 1 minute. Can I ask 2 questions? The first is, you said there's a client workshop in October. Are we aware of it? Is it everybody? Is it just for individual pension funds like ours? Perhaps you, because I'm sure we all listened to that and thought that's really interesting. And the second is a rather more blunt question, which I suspect only I will ask. You've had much too high turnover of your senior executives in the last 2 or 3 years. Can you try and satisfy me, if nobody else, that that is now a thing of the past and we won't be having multiple chief executives and chief investment officers?
Yes, sure, that's no problem, we can do that. So the client workshops will involve somebody from all 10 of our clients. So Dave will be representing Dorset from your perspective, and it's really good that you've had your strategic asset allocation discussions now, because we have a really good view of where you're heading, and Dave can bring that into the workshop so that we can then get consensus across all 10 clients as to where we need to move next in terms of product development, in terms of design, data analysis. You know, you've asked for more data. We're absolutely working on that at the moment. It's one of the things that the industry is really very poor at, is being able to produce that data. So again, it's slower than we want it to be, but we can only go at the pace of the slowest in the industry, and we're pushing very hard on those things. So I think that answers your first question. In answer to your second, this is a tricky one, because on the whole, Brunel has very, very low turnover. But yes, we have had turnover at the senior staff level. I think for me, what you'll find is quite often in a startup firm, the people that are there at the beginning may not be there into the business as usual type scenarios. And that has literally what has happened to us, essentially. And it's unfortunate that it's been at the more senior levels of the firm. But both Mark and Dawn have done an awful amount of time on the project pre-Brunel, and then sort of 2-3 years into Brunel. So it's not uncommon, to be honest. I can say the other pools have had an awful lot more turnover than we have. So we look very stable in comparison. Now, I'm not going to say that there won't be more turnover, because the non-exec contracts are coming up for renewal. So they do 3 years. And we've extended them for another year because of COVID, essentially. We wanted a bit more stability, but actually some of those may change next year as well. And that will then help us increase the diversity on the board a little bit more, which I can only see as a good thing, to be honest. So I can't absolutely reassure you.
No, that's fine. That's fine, Laura. I had Mark Roberts followed by Councillor Rice. I'll take Mark Roberts first.
Yes, it's a rather minor one, Laura. Thank you for your explanation, particularly of the direction that Brunel are taking. I looked at this report last night, and I'm not a pension professional. There were quite a lot of acronyms that I didn't know, and there was no name mentioned. I had no idea who the chief or the CSO, I didn't even know what CSO meant, and I had no idea of his name. Could you ensure your reports have a little glossary? And if you're giving a profile of a new appointment, could you at least name them at the top?
Thank you, Councillor Roberts. I shall ensure that James takes that forward in the future. I appreciate the feedback. Thank you.
Thank you.
Thank you very much. Councillor Rice.
Yes, I would just like to ask, in the briefing yesterday, you mentioned that we have divested from some companies already, such as Exxon. So it would just be really useful to know which ones you have already said, okay, we can't work with them anymore, just because the public want to know this. And the other thing is the 0 degrees portfolio on that slide there about the future. Can you just tell me a little bit more about those?
Yes. Yeah, so first off, as to the list, we can absolutely get you lists. Can I name them off the top of my head? Not at the moment. So I wouldn't put myself on the spot for that. But I think, and it's right, you should ask for a list, because yes, we haven't already made some decisions, and our managers regularly make decisions about whether or not, particularly in the active funds, they kind of have more of a comply or explain role with how they want to invest. So if we see things that are strange, we're going to ask them very firmly why they're including that in the portfolio. So we're already doing a lot of that work underneath. Yeah, so as to the IGCC work that's been going on at the moment, we're working with some other institutional investors to really try and work out what a good 0-degree portfolio actually looks like. So how do we pick the companies within that sector? Why do we pick them? How are we sure they're going to be 0 degrees aligned? Because those metrics aren't necessarily out there yet for all companies. So this will be an evolving piece of work that we are probably going to be doing for the next sort of 2 to 3 years, and it will be consistently evolving as the data improves across the board for these companies. So we need them to have really great disclosures first on a lot of things, or if they don't have good disclosures, we don't invest in them. So there's an awful lot of that work going on, which is fairly complicated and done at a stock by stock level as well. So it's not an easy discussion because no one's done this yet in the world. And we're really pleased to be participating in that because we have got some definite views on some of these things and what good and what bad looks like. And we'll see what the rest of the industry think of the work by the time we've finished it. So I think it will be a work in progress for a while to come yet, and particularly as government policy changes to support transition to the low carbon economy as well. So as that changes, our views might change as well. So I don't think we can say we have a 0-degree portfolio today and this is what it will look like forever, because I can definitely see a path towards a lot of change in the future, and probably faster than we can keep up with.
Thank you.
Thank you very much. I think that was a very comprehensive answer. Do I have any other questions from? I've got a hand up and I can't quite see whose it is. Hang on a minute, please. John Beasley.
Thank you very much, Vice Chairman. I'm very grateful to Laura and to James this morning for their presentations so far. And I know James is coming back shortly, and I hope that when he does, he's going to touch on the Brunel governance review, which I know, Vice Chairman, you and I have talked about aspects of, and I'm sure you will be reassured by what he has to say. And I think our last Brunel Oversight Board meeting, which was only last Thursday, we did quite a bit on responsible investment and the stewardship review. And I hope that the members of the Dorset Committee this morning have been thoroughly reassured about Brunel's credentials in terms of responsible investment, ESG issues, the carbon agenda, and so forth. And Laura makes a really important point, Vice Chairman, with regard to trying to get this balance right, the balance with performance in the longer term. And we have debates on that in the Oversight Board at every single meeting. And my take on it is very much that balance thus far is in harmony. But of course, if Dorset members between our quarterly meetings have particular issues that can be nailed by Brunel, I'm more than happy to try to facilitate that, as I have been from the very start. And playing the role in there on behalf of Dorset is one that, of course, is difficult to get back to this committee succinctly because there are so many issues being discussed. I though, in an overall sense, am very satisfied with the direction of travel thus far, the strategy that's been worked out and employed, and the degree of challenge that comes through the Oversight Board at every single meeting, and indeed the communications I have with particularly Laura and James and Denise Legall as the chairman of Brunel in between meetings. So I am there to represent Dorset, and I think my message is loud and clear. You've heard this morning what the executive members are doing and the way that they're addressing these issues. And I think I've got good grounds for having confidence in the way Brunel's going forward and the focus on performance in the longer term. Thank you, Vice Chairman.
Thank you very much, Councillor Beasley. If there are no other questions, I'll move on to Laura and therefore on to James, I believe. But Laura, do you want to...
No, James, over to you. Next slide, Dave. Thank you.
Okay, many thanks indeed, and to Councillor Roberts, apologies for not putting my name on there, and further apologies for putting my photograph on there as well. But I was asked to sort of to do two things by David Wilkes. One was to introduce myself and to explain the role of Chief Stakeholder Officer and what that means for Brunel and what that means for our clients and shareholders. And the second was to just discuss the governance review, which we've been going through, and which Councillor Beasley referred to there and has been sort of extremely helpful on. So first off, very quickly, my background, I've had about 30 years of experience covering principally equity markets, but economies, political structures around Asia. I would like to sort of think I'm sort of not so much an expert, but I'm deeply sort of embedded in the emerging market world, and also the challenges of how that part of the globe, that part of markets, is having a big impact in terms of the whole sustainability debate. China may be the world's biggest polluter, but they're also going to have more electric cars than anyone else will have around the world. So there are dynamics there which do balance up some of these points. So I've got a background in research, a background in client management and sales, and also done some work prior to leaving Hong Kong last year with an NGO which was very much looking at how you bring businesses together with purpose and profit. That's an organisation called the Shared Value Project, which was fascinating to work with. Dave, if you could flick through one slide quickly, that'd be great. Okay, right, CSO, Chief Stakeholder Officer. As you can see, we and lots of other organisations have increasingly complex sort of matrix of people who we work with, work for, and who own us. So what I've tried to do there is really just sort of highlight, with Brunel at the middle there, we are owned by the pension fund, we're responsible to the shareholders, and we support the investment officers such as David. But at the same time, we've got an intense...
Unknown participant is now exiting.
We've got a fairly intense engagement with the asset managers who we effectively employ on your behalf to keep them to the message that we expect, the investment policies we expect, and if they don't, we get them to either change their approach or we look to move on to use other managers. So that's one part of it. The whole responsible investment, the RI community, we're intensely involved with, and Faith Ward, who some of you will know, is on numerous bodies. I wouldn't like to go through how many, but her influence around that is great. And what I'm really doing here is looking to sort of assert Brunel's impact in that field and make sure that your interests and the company that you own gets credit for an awful lot of what they do. We've also got to link into government. Obviously, pooling was a government initiative, checking in with them, keeping abreast of what they expect and keeping them informed about our activities. That's a key part of the Chief Stakeholder Officer's role. And then liaising and working with the other LGPS pools. Obviously, there are 8 of us. We're at different stages of development, but we collaborate. We've done some great work with Borders to Coast on taxation, for example, bringing our resources together to create some really very good long-term tax savings for the funds. And that's the sort of thing which will flow through to your pension holders. Turning to Dave, if you could flick on a couple of slides, please, to there. Right, governance review. I joined Brunel in April. I've actually yet to go to the office because it hasn't been open. I've met some of my peers, but one thing which did become clear was there were some issues which needed review. As Laura had said, we're 3 years old. We were working to a shareholder agreement which was put together as the partnership was formed. There are lots of elements to that
Unknown
which have
participant
been,
is now joining.
there are lots of elements to that which have become slightly outdated, or rather are now just established business, which need to be updated in the formal documents. So I'm working through on that at the moment. That's a complex bit of work. In terms of the board and how our governance works from that side, we've decided to add a 5th non-executive director. That's because we are working in terms of adopting best practice from the corporate governance code. So the non-executives will have a majority on the board. We will have 5, and then there'll be 4 executive directors on the board. I'm also looking to just improve the communications and relationship between the board and shareholders. Some of that is one thing we're looking at, producing a newsletter potentially, which will work and come direct to shareholders and indeed committee members, just so you can see what we're doing, seeing what the important changes are that sort of really affect you. I've referred there to a consultation process as well, and I think this probably relates to Councillor Wharf's issues in reference to when things happen. So, for example, the departure of a CIO. It's sensitive. It's business. It's very business sensitive, and we're very aware that we wanted to make sure that we communicate these sort of issues when they arise. Hopefully not often. But we've put in place a process whereby shareholders can be sort of informed of things quickly where necessary, where we can reach quick agreement about significant issues before we then refer to client group and then to shareholders. So we've put that in place. And the final item there, some of the shareholders, some of the clients are looking for a shareholder forum to be established. It's not a majority. In fact, well, I don't know whether it is it may be a majority. We haven't got all their views in at the moment, but we're looking to reflect wishes from across the partnership for what might be another body which would help the governance of the group. So those really are the main things in terms of communication with the committee. Just come back to a specific, on a very sort of basic level, the information which Councillor Rice is looking for in terms of that coal divestment list, that comes down to me to make sure that you get that when you want it. When you want information, come to us, we'll deliver it. We're working for you on that. So always open to a call from anyone on any subject, and look forward to working with you all in future. Any questions?
Thank you very much. Members, can I thank you? That was a very complete and helpful and reassuring presentation. I think quite a lot of us took quite a degree of comfort from that. I'm looking around and I can see no hands up.
Alan, I think.
Ah, thank you, Alan. Alan Saunders, and you've dipped out, so presumably you've managed to get back in. Alan.
I have, thank you. I've gone to my iPad instead. Thank you both. Just a specific question about the quarterly reports. I know that we haven't touched up in the presentation. They're very helpful, but they are quite a hard read, and I'm not sure whether many of us actually get all the way through it. I wonder if you could have a look at that, James, with your new hat on, and see whether you can make it a little more user-friendly. You know, the text is very dense, lots of parts. That's my first point. The second point is, can I request we have more information on how the underlying managers are doing for each fund? We used to have that. We don't see the visibility anymore. So, for example, UK Active, we don't list who the managers are. Quite useful to know who they are and how they're doing. And I think then we'd have greater visibility. So we're missing something at the moment. That's easily rectified. Thank you.
Fantastic, Alan. I'm laughing because actually James's first task on coming into Brunel was to really review our client reporting, because we know it's not really where we want it to be, and it doesn't represent all of the good work that Brunel is doing as effectively as it could do. So I think we designed something at the outset based on what you had been receiving previously, But actually, we want to do better than that, and we need to do better than that. So I absolutely take your point. The other point on the managers is that we have heard this feedback from clients over the last couple of months, and we have been working on something that should allow us to be able to dig deeper with our managers and give you that information as well in a nice user-friendly format. So absolutely, I take your point and your feedback, and that's really helpful. So thank you, because that kind of emphasises the direction we're taking.
Thank you, Laura. Councillor Felicity Rice.
Thank you. Yes, a question for James Russell-Stracey. Thank you for your presentation. I was just interested in the work that you've done in the last year with the NGO and having profit and good coming out of a business. And I just wondered what your thoughts were on a world where all businesses run like that. Then we wouldn't have this concern about any of our investments. We would know that everything is benefiting everybody across the world. Do you think we could get to that stage?
Well, it's interesting. I mean, Hong Kong is basically the home to Mammon, isn't it? You know, profit is all it cares about in that town, supposedly. But there's a flourishing NGO philosophy there. There's a flourishing range of organisations looking to shift the way things work, and there's a new generation. And I think ESG is a generational change, and there are generational shifts within business management across the region, which are having really significant effects. So I'm very positive. What the pace of it coming through will be, who knows? But the Shared Value Project is actually, it's an international organisation, came out of the Harvard Business School. Sorry, I had a quick sort of break there. Michael Porter, George Seraphim, the people behind this. It's got operations in the US, in South Africa, in India, in Hong Kong and Australia. So there's a global reach to that, and I think it is an interesting area.
Thank you. Are there any other questions? Can I just confirm the need for more client-friendly communications, less acronyms, less complexities? Because even though, and having been a banker myself, I do understand it, but actually I don't need to understand it, and I often find you make better decisions if you lift yourself up from the detail and look at it in the round. By all means, use Dorset Pension Fund as a test bed for your communications, if that would be helpful. And I noticed my members all nodding, so there you are. There's not only a request, but I think you need to do that.
I think if I can understand it, you'll be doing well.
Yeah, thank you for your support. We do really, really appreciate it and value it. So thank you. I'm just sad that I can't be there in person to see you.
Well, we're all quite sad about that, because we're all finding this lockdown is beginning to lose any of the magic, if it ever had any. Right. I'm going to ask if members are happy that I close this item and move on to the next item. Howard Legge, you're giving your thumbs up, etc. Can I thank James and Laura? You gave a couple of very interesting, helpfully brief, useful, content-rich presentations, and we're very grateful for that. And you are always welcome to come. We appreciate how busy you are, but I personally would think it would be helpful if you tried to visit us, you know, at least once a year, and preferably a bit more often than that.
Agree. Thank you, Chairman.
Absolutely. Look forward to it. Thank you, Chair. Thank you all on the committee. Many thanks.
That's fine. You are welcome to stay for the rest of the meeting. This is what we say to all people who come and give presentations. And oddly enough, I expect to not see you within about 30 seconds.
Thank you. All right. Thank you, everyone.
You are welcome.
Many thanks. Bye.
We're now going to move on to item 9, which is the Independent Advisors Report. Alan Saunders, for the benefit of the public, is our independent advisor, who is a specialist in this field. He writes a report which is in the minutes, and he talks us through that report. Alan, you are now on, and we expect your usual useful, short but interesting summary of the market. Alan.
Thank you, Chairman. I think I'm rather exhausted by the debate we've had so far, so I shall be brief. And I should mention for the public that I advise pension fund on behalf of MJ Hudson, which is a city investment consultancy. So I read this report 3 weeks ago. I wrote you in March and again in June, as we've had the ebbs and flows of financial markets. And of course, because we have a lot of our assets and risk assets to get to our challenging 5% return, we're going to go up and down with the markets. And we saw that with our overall value. We're almost back to 3 billion, and the officers will take you through that in a second. So we've recovered a lot of the lost ground in the first quarter. The UK market, it was down 10% in the first quarter, up 20% in the second quarter, but we're still down 15 to 20% from where we started the year. That's very volatile. But the US, as we all know, is actually back to year-end levels, quite extraordinary, and that's mainly down to the technology sector, which is establishing new highs. And although we've had some sell-offs, Tesla, I think, fell 10, 15% a couple of days ago. That is still keeping the S&P, which is the benchmark index, at very high levels at year-end or slightly better. So as we look around the world, a lot of recovery. The UK market has lagged behind, as it has done for the last 2 or 3 years, and that's one reason behind our strategic decision to move away from the UK towards global equities with a much larger commitment to, for example, technology stocks. The recovery has been extraordinary. I say in the text, it's the sharpest recovery since 1929, I think. Normally, it takes about 4 years to go from peak to trough and back to peak again. The US market has done it in 4 months. So that is remarkable. And maybe markets are slightly ahead of themselves. I've characterized this as a relief rally, but it's been an extraordinary rally, and it's gone further than I expected when I said to you markets will recover in March, a lot further. And it's obviously banking a lot of the economic recovery we hope to enjoy. I think at the moment, it's fair to say markets are consolidating. The FTSE 100 is struggling to hold the 6,000 level. It's been around that for the last week or so. And the S&P is giving back a bit of ground. But on the whole, we haven't surrendered too much of the gains. I'm going to give my conclusion first, which I think markets are going to sort of remain around these levels, but we will get a lot of volatility. And the reasons for that are pretty obvious, all of us. We've got a rise in infection rates now in the UK and in Europe. It hasn't gone away in the US, and it's colossally concerning in emerging markets like India, South Africa, and so forth. So that's one background factor. We also have, of course, in the UK, to be specific, the withdrawal of the furlough scheme in October, which has been so helpful. And we just don't know what the impact on the employment market is going to be as a consequence of that. If I look at the US for another example, Congress has not yet agreed the new package, which was meant to replace the old package, which is expiring, of a fiscal support. And that, of course, could be a concern to equity markets. In Europe, surprisingly, we have now an agreement on this 750 billion euro package to support the weaker economies like Italy, Greece, Spain. So that's gone through. So that's a positive. But there are clearly so many hurdles out there to stock markets going further that I think it's right to take a cautious stance at this level. Where do the economies stand? Where do we expect them to go? Well, the Bank of England's come out with a more positive projection on its earlier forecast, which is very gloomy indeed. It's now suggesting that we could get quite an upward trajectory in this quarter. The recovery started in May, to remind you, halfway through the second quarter of the year. So that was already, we've got a bit of a V shape, but that probably isn't going to continue for much longer. But the Bank of England's latest forecast is a fall in GNP this year of 7 to 8%, which will mean at the end of this year we'll be 5% lower than we were a year ago. That's obviously a colossal hit. What does that mean for unemployment? We haven't seen any rise in the unemployment numbers yet, 3 to 4%, so a very low base, thankfully, we start from. But that's likely to rise to 7% by year end. Next year, the Bank of England, I think, projects a forecast of 4 to 5% in GNP growth. So by the end of 2021, we'll be back where we were at the start of the year. And equity markets probably will be reflecting that. It's very hard to read how far the recovery will go and how sustainable it will be, because there are going to be these continuing worries and disturbances as we go through the infection. In terms of other markets, we've had a recovery in the corporate bond markets, and we still have exposure there. Spreads have narrowed in quite a lot. One of the stabilizers to our portfolio has been, bonds. Property market, probably we've seen a fall in capital values of around 5 to 6% so far this year. Property has a high running yield of about 4%. But of course, as we know, in areas like retail and office, rents haven't been paid. I think in retail, only 50% of rent's been paid so far. So we will have our income stream affected by that. We also have one or two areas of slight vulnerability in our property sector. In hospitality, we've got a chain of pubs, and we have a hotel, and clearly hotel occupancy rates are well down at the moment. But as I've said so many times, we have a very well diversified portfolio. We suffered on the way down, but we bounced back quite smartly. Our LDI portfolio, we've reduced the inflation hedge, so that's reduced some of the volatility. As I mentioned at the training session yesterday, we took a big hit in the fourth quarter of last year when the government announced it was going to review the RPI linkage for index-linked bonds. That's very concerning to us because our liabilities are CPI hedged, and that mismatch between RPI and CPI, roughly 0.8%, it's now come down to about 0.5%. So we lost money in the fourth quarter last year, the first quarter this year, but we had a great recovery in the second quarter, which reversed all of the losses in the first quarter because the price of inflation has gone gradually up. If you look around you, obviously prices are very stable, wage rates are under pressure, so there's no short-term risk to inflation, but many people are fearful that this quantitative easing will have very long-term consequences for inflation, and we might well see some rise in inflation beyond the 2 to 3% on a medium-term view. I've gone through this without mentioning Brexit. That is another uncertainty I should have mentioned. Of course, we don't know whether there will be a deal. If there isn't, we have to assume some short-term dislocation to the economy, both on the supply side and the demand side. Exports to the EU could face 10% tariffs, and supply chains will be affected. There could be queues at Dover. We just don't know yet. But that might engender some downside risk to the forecast next year that we'll have a 45% recovery. So to wrap up, markets have had a terrific recovery, more than one might reasonably have expected. They're pricing in a lot of economic recovery. They may be disappointed. Much depends on the infection rate, and much depends on how governments can sustain this continuous fiscal support for markets, and the Chancellor said he's going to start reining that in. That's a concern. So equity markets, having achieved this level, if we're still at these levels by year end, I should be feeling quite pleased. Thank you, Chairman.
Thank you, Alan. There's no hands up, so I'll ask you a question, which I was going to ask anyway. Do you have a view as to what the implications of a second spike would be? And is there anything we should do or think about if there were to be a second spike?
Well, of course, that begs the question of whether we're starting the second spike already. And if you look at somewhere like France or Spain, you might feel they're already in that scenario. That might encourage the government to extend the furlough scheme or to maintain the other measures of support. We'll certainly encourage the Bank of England to carry on with quantitative easing. But I think it'll be damaging to sentiment, won't it? I'd have thought. And then we'll be seesawing between the bad news from rising infection rates and the hope that governments will respond still more with more fiscal stimulus. But how far can they go? The budget deficit for the UK this year will be 300 billion, 15% of GNP. We've never seen that other than in wartime circumstances. So there are constraints.
Okay, thank you. Any questions from members? It was, as always, a very interesting, thought-provoking review. If there are no questions from members, I can't see anything. If there are no questions from members, I'm going to move on to the next item. Right. The next item is pensions administration, which I believe is Karen. And on my individual chat line, I've asked Karen and David to be brief. Karen, David, you've got your hand up. David,
yeah. Apologies, it's the fund administrators report first, and then the administration.
Sorry, I'm looking at two screens, and that's quite tricky. Sorry, David, you first. Go for it.
But I will be as quick as I can. So I'm just going to highlight a few things in the executive summary and then open to questions. So as Alan has said, the rebound in the quarter, we've seen the value of our assets recover to just under 3 billion. I think we could round that up to say it's 3 billion. Obviously, we've seen a rebound in the markets. Clearly what's happened since March has had an impact on our funding position. So the value of our assets has gone down. So we asked the actuary to do if you like, a quick and dirty review of our funding position at the end of each quarter, in between their full assessments that they do every 3 years. And you can see that the full position at the end of March 2019 was 92% funding level. So our assets met 92% of our estimated liabilities. You'll see that that has dropped down to 85% as at the end of June. The way that Barnett Waddingham value our assets is they smooth the value of assets over a 6-month period. So in the first quarter of the year, that funding level would not have dropped as much as if they did it based on quarter end valuations, but equally it hasn't rebounded as much perhaps in that second quarter as it would have done. So I think we still kind of see, as Alan alluded to, there's going to be a lot of volatility still, and we kind of see where that moves, and hopefully it can start moving back in the right direction. So we've got some figures there in terms of the quarterly returns, which again, as Alan's alluded to, so over 10% in the quarter to June, slightly ahead of the combined benchmark. But over the last 12 months, you can see actually there's been a nearly 3% reduction, negative return on our investments, which is clearly below the discount rate that we've discussed quite a lot today and yesterday. As at the end of June, just over a third of our liabilities were hedged against inflation sensitivity, compared to our revised target of 30%. As mentioned there in terms of some of Mark Mansley's departure, and we've heard from Brunel about that, and obviously we've been introduced to James Russell Stracey as well today and heard about that. One thing that I don't explicitly mention in our report is, as at the end of June, approximately 40% of our assets are transferred across to Brunel's management. Subsequent to the end of June, we've also seen a transfer from Barings to the Diversified Risk Fund that is newly launched by Brunel. And as a result of the changes to the strategy that we agreed earlier, I think we'll see that percentage quickly tick up to over 50% and start approaching maybe two-thirds of our assets to go across to Brunel over the remainder of this financial year. Last point on there is that our draft pension fund accounts have been with our auditors and are still subject to that audit, so they are not as yet ready for publication. This isn't because of any problems that the auditors have flagged up. We've seen delays in terms of producing accounts this year within the council and in the wider local authority space, and that's also had some impact on the planning of auditors as well. So the planning process for when auditors are available to do audits has suffered a bit as well. So we're hoping to get some final comments from them shortly in the next week or two, and we'll be chasing them to do that. That's all I wanted to say, Chairman. Happy to try and answer any questions that committee members may have.
Thank you very much. Do either of our finance chiefs, Jim McManus or Aidan Dunn, want to say anything on this? No, there are no hands raised. There is a hand raised from Alan. Alan.
Could I just make a comment on the performance figures, which we get from Brunel, and they come from our custodian. And members will have noticed a disconcerting move into negative territory against our benchmark recently, where we've been accustomed to many years of outperforming our benchmark. So I think maybe some explanation could be offered there. Typically, when you underperform a benchmark, it's either down to asset allocation or stock selection. In this case, I think it's partly down to our benchmark selection for at least two of our managers, where we use a cash plus 4% return. And we're in risk assets like the Diversifying Growth Fund, which is 60% in equities, and our MAC, our corporate bond manager, which is in leveraged loans and high yield. So those benchmarks become rather challenging. And when both fund managers are down 5% and the benchmark is up 4%, that has a big weighting on the overall return. Might explain why we are lagging behind benchmark for the last couple of quarters. I think I'd like to sit down with Dave and maybe just review all the benchmarks we have for each of our asset classes, Chairman, at some stage.
Okay, can we, Dave, can you minute that as an action? Because I'm sure members would want that to happen. I've got Councillor John Beasley.
Thank you very much, Vice Chairman. I just wondered whether David or somebody, perhaps Alan, could just comment very briefly on the private equity portfolio, its relative performance, which is quite stark, and how current market conditions might affect those investments looking forward, particularly post-COVID.
Thank you, John. David, start with you.
Yeah, I'm just trying to find some of the facts and figures.
I'll come back to you if you want.
Yeah, I mean, one of the things just to note in terms of the private equity performance, which I think kind of comes back to the point that Alan's mentioned, that the legacy holdings that we have with Aberdeen Standard and with Harbour Vest are linked to, they're actually linked to a listed markets index. So in the first quarter of this financial year, the performance, but yet there's a lag in terms of the valuations of private equity because of the nature of the fact that they're not traded on a frequent basis. So the last quarter, we would have seen in relative terms against their benchmark, we would have seen an outperformance by our private equity holdings. And because of the fact of the lag in the quarter we've just seen, we're seeing the opposite. So the poor performance or the underperformance that we saw in our listed markets in the quarter to the end of March was kind of didn't feed through to the private equity valuations until the quarter ending 30th of June. We also have one of our legacy private equity managers, Harbour Vest, is in a US dollar denominated fund, and we often see that some of the outperformance that we see from them is not just a result of their good management of the assets that they have under their management, but also in terms of currency movements as well. So when there's a strong dollar or a weak pound, that's often reflected in a boost, if you like, to the performance of those funds.
Thank you, David. Alan, do you want to come in on that?
Not much. We don't have great visibility on these two, and maybe Dave and I should go and see them at some stage. We don't have any concerns, and Harbour Vest have done very well over the years. Aberdeen Standard Life a little less well, but I think we're fine with them.
Okay. Andy Canning.
Yes, thanks. Yeah, I think the relevant thing with private equity is to look at the longer term performance. If you go back over the last 5 years, you can see that both of them have significantly outperformed. But I do remember we've all had other quarters before where there's been a big discrepancy between the quarter performance and the benchmark performance due to the lag that's been referred to. But if you look at the 5-year rolling performance, it's truly outstanding, particularly for the Harbour Vest funds, which we've done consistently well for a long period of time.
Thank you, Andy. That's reassuring. Thank you. Are there any other comments? If not, can we accept this particular report? And we therefore move to the next report, which I hope get it right this time, the fund administration. Karen.
Hello and good morning. I'm sorry, I don't think you can see me because my camera's not working. Apologies for that. Although you might think that's a good thing. I'm not sure. Okay. I know we haven't got a lot of time, so I'll try and keep this brief. Hopefully, you've seen the sort of report that I did for the board meeting we had in July, and some other updates that we've provided to the board and the pension fund committee of what the administration team has been doing over the past 6 months. So hopefully you've been aware of that.
Unknown participant is now exiting.
I haven't sort of gone back over that for you, and I think there's quite a lot in this report, and we are probably entering into a really busy time for administration with some really big and important issues going on. So I'll just go through this briefly for you to keep you updated. Some of it is just very straightforward, just to let you know. The end of year processes and annual benefit statements, all is good there. We're obviously concerned about the end of year processes because the employers were obviously working from home. We did extend the deadline for them, but the data was received and it was of good quality. So the employers did make an exceptional effort. We have got some problems with some employers, and we'll be addressing that through our admin strategy. But to be honest, we usually do. We've probably got as many issues, probably even less this year than on a normal year. So and those will be addressed. So the annual benefit statements went out well within the statutory deadline, and you'll see the statistics of those that sent out. We are still sending out paper annual benefit illustrations. They also do go online to our online portal, and members have the option to opt out of receiving a paper statement if they want. We don't have many that want to do that. Probably about 4 have got in contact to say that. But the majority of members really do appreciate receiving this, and we do take advantage of this annual communication to raise the profile of the scheme and to remind members of the benefits of the scheme, etc., and to inform them of, particularly important messages. And there was quite a few important messages that we needed to deliver, particularly this year, but there usually is every year. So there's a really important bit of communication. And just to let you know, we use an external printing company for this annual exercise, and the cost of sending out these statements is very small. I think for the active statement, which you'll see is attached as an appendix, and the annual newsletter, all of which is in good quality and in colour, the total cost of printing and enveloping and posting of that statement is 72 pence per member. So it's a really modest cost. So we use a very good provider for that, and members seem to really engage with us. We get really good feedback, and it delivers those essential messages that we want to get out to members. So it's been very valuable this year. Just to move on to the data quality reports, this is just to inform you, we do this, of course, every year. We now have to report, as do all pension funds, add data scores to the pension regulator, and these are scores that are published in our annual report as well. So there's 2 scores here, the common data, which is one that's applicable to all pension schemes, and the scheme-specific data. So that will be data relevant to the LGPS. And you can see the scores there are excellent, very slightly up on last year as we gradually improve. I think these scores are probably about as good as we can get. So our aim is to maintain and to increase those if at all possible. So we will obviously keep you informed of those, because we do have some big changes coming up over the next year, which might give us some challenges. But I think what these good scores do show that is very reassuring for us all is that we do have a really good relationship with our employers. We really do work on that. They are giving us good quality data, which is not easy for the LGPS because it is such a complex scheme. But I think, overall, we should feel very confident that we're paying the right benefits to our members and that our valuation is accurate because of those data scores. It was mentioned at the last pension fund committee about the review of our in-house AVC provider. We have done this, and we appointed Hyman Robertson to do this on our behalf. I haven't attached the report. The report is available. The report was done to review our current arrangements and to look at things like the investment options and whether Prudential was the best provider out there in the market at the moment, for example, and to advise us on further actions. Now, there are some further actions to be taken, including looking at revised default standard investment routes for the fund, because I think currently our default investment option is with profits, and we've been advised to move away from that. So it's not necessarily our area of expertise. So I wonder if we could have anybody that might be willing to
Unknown participant is now joining.
Offer to look at this with us. I mean, I probably need a couple of people to look at us. Does need to be reviewed, and then we can make the recommendations and take those forward. I won't go into the details of that, but you'll see the key
Unknown
points
participant
there.
is now exiting.
One of the most important things really is the question of whether Prudential remains our best choice as a provider. I think you'll see at 12.4 that Hyman's recommend that Prudential remains as the main provider for the time being, and they have given their reasons in their report. However, they advise that we keep this under review. So I think that's sort of reassuring. If anybody would like the full report or anybody would like to get in touch with me, I would appreciate some input into those suggestions for moving forward.
Unknown participant is now joining.
So moving on to 13, which is the exit cap. This is sort of quite swiftly moving news, unfortunately. You'll remember that we did a consultation response and we spoke to you previously about the exit cap. And there was certainly amongst the board members, there was some strong views over the proposals in the government's report previously. Just to let you know that on Monday there was further consultation that's come out, and in it, unfortunately, was more than was expected. So the government have also really looked at other further reforms, as they are calling them, and the extent and the impact of this is now more. So this is now out of date. Since I wrote this, it's been sort of overtaken. I've been in a meeting this morning to discuss the contents of the report of the consultation, because there is some confusion over it and some concern over it because it's not as expected. For example, there is going to be an impact to members over 55, to all members, whether they exceed the cap or not. So any member over 55 who is made redundant, where there is a strain cost, there will be a financial impact and a loss of their severance payments. So there's a lot of work to be done there, and I've got another meeting tomorrow with the LGA to make sure that I understand this. This is going to have quite a big impact on employers who may now want to be looking at rushing through redundancies. The issue for us is the complexity that this is giving means that members in this position looking at redundancy who are over 55 will now have 4 different options potentially to choose from in regard to their pension and compensation payments. We're waiting on GAD to issue new factors so that the strain cost calculation is standardised across the country. We don't even have that yet. They've said we'll have that in a few weeks' time. It does mean, and we've also heard that the government wants this through by the end of this year. We need changes to the LGPS regulations. There's going to be changes to the compensation regulations as well. So after a huge delay in the government sitting on this for a long time, they now seem to want to be rushing it through. This means that we're going to be doing a lot of difficult calculations manually under pressure from employers and from members who will be anxious, of course, about what their pension and retirement packages will be. So very difficult for employers, for members and for us. So I'll keep you informed of any developments there. The other big impact, of course, is in regard to the McLeod consultation, which is out at the moment. This is a huge impact to us as well. A particularly large impact to the administration team, which I don't think can be underestimated. And we do need to draw this to your attention because the cost of implementing this is going to be huge. We're not particularly impressed by some of the suggestions in the consultation, and we've had some meetings with our Southwest colleagues and with MHCLG and LGA to discuss this because the impacts are so significant. Particularly when you consider that the number of members that are affected are quite small. So there's a lot of complexity in the LGPS, very difficult. It does mean that we will be revisiting, there'll be the need to revisit thousands, literally thousands. I think we've got about 24,000 members that will be in scope for this, and thousands of calculations will have to be revisited. And despite the LGA's optimism, a large majority will have to be revisited on a one-by-one basis. This isn't something that can be done by our software because of the complexity of the service records and the data we hold. It's just very, very complicated. So just to let you know that the actuary should have taken into account in as much as possible McLeod in the last valuation as well, but I will keep you updated on that because that will have a significant impact on us moving forward. The local pensions board has reviewed the risk register. That's at item 15, just to let you know that that has been reviewed, specifically in regard to COVID, and you'll see there at 15.2 some of the main risks highlighted that had been presented by the pandemic. There hasn't been any serious impact to us in terms of employers. We haven't had any employers unable to pay their contributions, for example. We haven't had any employers go bankrupt, but that is, of course, at the moment it's still very much an ongoing situation. We have had one employer adjust slightly their contribution, but that employer was already in a difficult position prior to the pandemic, so nothing too serious to report there. The only other risk that's not mentioned there is the risk of home working, which unfortunately is not ideal for the administration team. It suits us in part, but not completely. So that's not ideal for us in terms of risk, which is something that we're having to manage with our data protection colleagues. Just moving on to item 16, that's the latest amendment regulations number 2. This is quite important to employers and to the pension fund, and it certainly will be interesting to see. One of these amendments, there's 2 amendments here, is very much needed by us, and that's the dealing of an employer who's leaving the fund with a cessation debt. So this is the flexibility on exit payments. Prior to this change, an employer leaving us with a cessation debt had to simply cough up the funds, and that was fine if they were modest or they were able to do so. But if that would have led to that employer going bankrupt, that was not ideal for a number of reasons. So I think public sector is taking a bit of a long time to catch up here. This is certainly something that's available in the private sector and has been for a long time, to enable that employer to remain having those liabilities within the fund, and with pre-arranged agreement, making a prepayment schedule, or that employer remaining and having a deferred debt agreement. So that's welcome news. We've got a couple of employers who are on the point of cessation that have been waiting for that to come through. There's also, in with that same amendment, the review of employer contributions. So I don't know how often this will be used. It will be something that will need to be worked into a policy, so that it's not sort of putting the fund or the employer or the membership at risk. So that's something that needs to be done. Item 17 is the National Knowledge Assessment. I'll just highlight this because this is relevant to future governance in terms of local pension boards and pension fund committees. So there are changes ahead for that. Item 17, this is to let you know that the administration team is facing, not in particularly good timing, unfortunately, very large changes to our systems, which are, of course, really crucial to what we do. So unfortunately, we have lost some add-on systems that we've had for a number of years now that have been really, really valuable to us. So this is our case management system and our employer portal. And we've also the same supplier, which is the London Pensions Partnership, is withdrawing our website as well. So we're now in the midst of a procurement exercise because it happened that our main software supplier, the contract's up for renewal next year. So we're going through a very large procurement exercise looking at all of our needs because we obviously want to continue to provide our employers with an employer portal, and we want to continue to provide the level of service that we do at the moment. So we're anxious to make sure that we have the right outcome from that, but it does mean that we're facing big changes right at a time when there's big changes going on in the industry. So that's going to be a bit of a challenge for us. And just to let you know, in regard to that, the withdrawal of the website provision is for the end of September. So we have already arranged to replace that. That's being replaced by 2 websites, one for members, and that's being provided by Hymans Robertson. So it's a sort of an off-the-shelf LGPS members website. So it's very user-friendly and very nice for them to use. It's a very modest cost to us, and we can put our forms, etc. there. But we weren't able to incorporate our employer's website on that. That's really important for us, our employer's website, because we put so much information, process information and forms, also everything for our employers to enable them to do their function for the LGPS. So we've actually done that website ourselves and built that ourselves. So it'll be probably a little bit more of a straightforward website, but it will have everything in there that we need for the employers. And those websites are going live on the 1st of October. Just as well to let you know that it came to light that Weymouth and Portland Health Authority had been omitted accidentally from the LGR negotiations and discussions. But those staff, and there are not many staff, I think there's literally a few deferred and about 3 active members at the time, had been TUPE transferred over to Dorset Council at the time of LGR. So it's not of huge impact or significance, but obviously we've just highlighted that to our actuaries and made sure that Dorset Council are aware, and that's been noted by the legal team there. The final thing on here is the key performance indicators, which you'll see it's an appendix. And what I've done here in actual fact is I've just given you a comparison for last year, the same period of time. So this is the period of time since the last report was provided to you. So this covers the period from February to July. And I've given you a comparative period for last year to see the difference. And you'll see that the number of cases completed is lower than the same period last year. Just to highlight a few things, obviously this isn't all the work we do. Last year there was some work to do to tidy up data, to address certain issues. We did a lot of tracing, for example, on some of our refunds that have been around for a while. And we had an aggregation project which led to a lot of deferred benefits. So there was some additional work going on last year. But I think it is fair to say that the home working is not ideally suited to us in some regards. So it has had an impact, but thankfully not as huge an impact as I've first feared. Also to point out that you'll notice correspondence has gone down, but I would probably say that it hasn't gone down, but much more of it has gone onto email, because that correspondence will be to do with paper correspondence. And obviously we're now in a situation where most people are contacting us via one of our several email inboxes that we have, and that work has gone up. So that's a bit of a brief run through for you of some of the sort of main things at the moment. And I don't know if anyone has any questions.
Thank you, Karen. Howard Legg.
Yes, if I may. Thank you very much, Chair. This actually is on the very last topic you've done, because I read through earlier on, and page 357, the appendices are on the circulation of the agenda that we got sent to us last week. It's these KPIs again. Indeed, the number of reds you've got on there have gone up from 3 to 6, and the number of greens have gone down from 5 to 2, and the number of oranges have remained the same, although they're different ones. And I accept that the KPIs have suffered a knock because of home working, but we are likely to, or are you likely to continue with home working at least until March? And if so, how is it that we're going to try and improve these indicators? Because basically that's the level of service which we ought to try and endeavour to raise again. Thank you.
Thank you, Howard.
Yes, thanks, Howard. I mean, some of these things are, as always with these things, a little bit of statistics aren't all that helpful. So, for example, admissions, they're always done on time, but unfortunately, there has been 1 or 2 issues with people not using our workflow system correctly. So there are some things there that aren't as they seem, and are better than they seem, and admissions has not necessarily got the impact. Our main concern is over retirement benefits, the payment of benefits, retirement benefits and death benefits. So that's where we're really concerned, that we want to make sure that we don't fall behind. Transfers can be problematic if there's a slowdown. Unfortunately, transfer companies do send us paperwork, and there's a lot of paperwork involved in those. So that is a challenge to us during home working. But we are trying to work on that, not because it necessarily has an impact to members, but it can lead to complaints and complacency, I feel.
Karen,
so we're working on that.
Karen, can I half stop you there? You're almost saying it's not quite what it seems, but we need to change it so that it is what it seems, because I'm with Howard. These are concerning figures, and either we need to amend it in the light of reality, or we need to recognise that we've got some issues. So it's the fag end of the meeting, so I'm a bit concerned, but I don't feel very comfortable. I'd share Howard's concerns, and your comments were almost rationalising it. Just hang on a minute, Karen. David, what actions are you taking to ensure that this is improved? David Wilkes?
In terms of administration, that's Karen's area of responsibility, reporting into Jim McManus.
Okay, I'll ask Jim. Thank you, David. Jim, what actions are you going to be taking to address this area of concern? And Jim, you are there.
Do you want me to answer that?
Chair, it's Aidan. Shall I come in on
Yeah.
that? Yeah, hi. Yeah, good afternoon, everyone. Howard, just to respond to your point in particular about the administration team, yes, we are assuming, and they should plan to be working remotely until the end of March, as with all Dorset Council employees. So we've got another, 6 months of this at least. The pension administration team, as Karen's just outlined, some of the paperwork comes in through the post. So we've got a number of the team do come in and work in socially isolated groups within the office. But there's no doubt about it that the consequence of responding to COVID and home working is impacting on performance. And we're seeing that in other parts of the council as well. But we are working with Karen on trying to improve where we can on each of these. And as I say, it's a difficult time contextually. Karen's just pointed out that the really, really important ones of these indicators to us we're still performing highly at, in particular DR23 around deaths. But we're carrying on working with Karen to try and improve the performance generally. And I think next time we meet, we'll see an improvement.
Okay, Howard, are you comfortable with that answer? Do you want any actions? I mean, I'm inclined to say that this needs to be both on the next agenda and a bit more upfront.
It is. I quite agree. But can Karen and Aidan and others? This is not a criticism. I think probably they're working very hard and probably beyond the normal demands. but there's clearly a lowering of standards in some way, and we've got to try and get them raised back up again. But I'm sure the staff are working extremely hard, and I do understand that. So there's a lot of criticism.
I share Howard's concerns, but I also have concerns that the performance, if this happens 2 or 3 times, we need to do something about it. I'm going to go to John Beasley and then Mark Roberts. Councillor John Beasley. Councillor John Beasley, you're on mute. Thank you.
Well, I flicked off and flicked on again. Apologies. Thank you, Karen, for your very helpful and comprehensive report. I wanted to raise 3 things around the MHCLG consultation. And I do so as a member of the Scheme Advisory Board at the LGA, and the opportunity that gives us to get fairly direct feedback enacted. I'm on there essentially representing the county schemes, so it's a large part of the LGPS. The 3 things, Vice Chairman, are around, first of all, the issue of the exit cap. And Karen's absolutely right, that is moving at some pace. And the government seemed to be intent on getting to a conclusion much more quickly than they were. The impacts of that, which we might want to make representation on if we haven't already, the impacts of that are around post-COVID restructuring and redundancies, and could have an impact on any restructuring that we might be wanting to do in either or both of our unitary authorities, and trying to get this level playing field around the strain cost across the UK. And I just wondered on that one whether there is more that we should be doing to represent. The second is about McLeod and the update that's in the paper at page 281, because that is again moving along, but not at such pace. But the financial implications and the administrative implications are huge. And I was surprised actually to hear Karen say that they aren't being emphasised that strongly by the Scheme Advisory Board or the LGA, because certainly my experience has been that we are very, very concerned about it. And the third one is around the administration impact on page 316. And some questions are raised there about how we deal with those. And I'd add to that the financial costs. We've heard the statistics from Karen, which frankly are almost mind-boggling for a fund with the administration the size that we have and the number of people able to be undertaking that work. Again, we need to reply robustly, I think, to those questions on page 316. And finally, Vice Chairman, I'm very happy to take those issues back strongly on behalf of officers here at Dorset, no doubt much wider still. And I will make sure that the chairman of the Scheme Advisory Board, Councillor Roger Phillips, gets those firsthand from me as well. And I'm sure that Jeff Houston at the LGA will also be continuing to make those robust representations to government, to MHCLG. Anything I can do to help, let me know.
John, that's very helpful, and that was exactly what I was going to ask you to do, so you've read my mind completely on that. And David Wilkes, if you can make sure that that's an action in the report. I've got a couple of members first, Karen, but if your point is something that needs to be said now to correct, then come on in.
I was just going to really respond to John, and just sort of to come into there to say that you know, it's really important, and we are, you know, communicating with employers. We will respond to the consultation on behalf of the Dorset County Pension Fund, not as an employer. So we really want employers and need employers to respond as well. So employers do often struggle with consultations, and we're trying to support the employers and encourage them to respond. So I've already spoken to Dorset Council, HR department, and I'm sure they will respond, because you're quite right, the impact of this is huge. So we are working with employers to try and make sure that they understand, because the consultation isn't well worded and has been some very important points have been missed by people already, you know, which I've raised straight away with the LGA, because people are missing some of the big impacts of this. So we do need to get employers to respond to the consultation. The point about the LGA and MHCLG has come really from a meeting whereby I think they are under the impression that quite a large part of dealing with the McCloud can be done by use of our software. And what I'm doing in the midst of a piece of work is to get more detail of what needs to be done, because unfortunately what is hard to understand is the complexity of the records that we keep is such, and the complexity of the LGPS, that a software solution is a bit of a pipe dream, certainly when you're looking at an entire solution.
So Karen, I'm happy with that, but I'm going to go to members because I've got some questions. I'll come back to you, Mark Roberts.
Yes, thank you, Peter. It was only a brief one. I had to wade through an enormous amount of the appendices and extra stuff to find the traffic lights or the colour, the KPIs. Could we please have the KPIs at the beginning of the report, of this administration report?
Absolutely.
We've had a lot of talk about it, and I think it should be right in front of us rather than wading through.
Yeah, that's what I said earlier, and I think I'll talk to David Wilkes and the chair. We may want to have that as a separate short report up front, because there's a danger that we'll confuse lots of details with some outline management of the key red areas, which I think could come on up front. Councillor Andy Canning, Chair. You may be on mute, Andy. Your hand is up, but you are here, and I can see you on the icon on the screen. Andy, I will come back to you. Karen, I will come back to you in a minute, but I do need you to be brief. We have had a pensions committee item where we discussed the strain and the government's objectives, and we made our views known there. But I would like it to be on the next committee meeting so that we can review progress on it. Andy, are you back and capable of speaking?
Unknown participant is now exiting.
This unknown participant keeps coming and going. Right.
I think the unknown participant is Andy, isn't it? Coming in and out, I think.
I think he's on his mobile trying to ring in and out all the time.
Unknown participant is now joining.
Right.
Unknown participant is now exiting.
Sorry, I shouldn't laugh. Right. David, did you get that request that we have this on the next agenda and we have the metrics quite early on so that we can judge them when we're at our brightest? Aidan Dunn, you wanted to speak.
Yeah, thank you, Aidan Dunn, Exec Director. Peter, can you just clarify that point on the pension strain? Is that the £95,000 cap? You want to explore that in more detail on the next agenda? Because so, as Karen said, the government previously consulted. They want to implement the cap. They've agreed they're going to implement the cap. It's how it's done and what the implications for us. So we could have a separate agenda item for that. The consultation closes at the end of November. So depending on timing, we might have to do something sort of with a small subgroup, perhaps.
Yes, yeah. Although we did at a previous meeting, we gave our sense of our response, and I saw some time ago our response, which I think adequately reflected that. But I think nevertheless, if there is any change in it, we should involve members.
Okay, thank you.
Yeah. Karen, I'm gonna ask you to be brutally brief because I'm going to bring this meeting to a close if possible.
That's okay. I don't have anything further to add.
Unknown participant is now joining.
This unknown participant, Andy Canning, you had your hand up. You look as though you've come back. You're on mute. You're on mute.
Can you hear me now?
Can do, yes.
Oh, good. Yeah, I was going to say, I think rightly this time around, we focused very much on the investment side of things. But our priority for the next meeting, I think, should very much focus on the fund administration part of our responsibilities. And I think, as has already been said, I think we should put that first on the agenda for our next meeting and really get into the depths of what's going on there. And hopefully it gives 3 months as well for Karen and Aidan to work on how they can deal with some of those situations as well. And hopefully report back to us some improvements next time.
Thank you very much. Can I take it we've finished on the pensions administration? Item 12, there's an item that I want to raise before that, which is the Brunel presentation talked about a workshop. John Beasley, are you our representative at that workshop in October?
I haven't got any details for it. I'm wondering whether David can help me out on that, because when we heard the presentation, it was one that had been set up, I think, for officers, and I just need an answer from David first.
Right, David Wilkes, you've got your hand up.
Yes, yes, Councillor Beasley's correct. It's an invitation to pension fund officers, investment officers. So I have that in my diary. Obviously, I'll feed back to the committee as necessary.
Well, as it relates very strongly to Councillor Rice's conversations, A, can you make sure that that is on the agenda, excuse me, for our next meeting so that you can report back? And B, can you make sure we have an agenda item that relates to proposal 2 that Councillor Rice raised, please, so that we have that? I'm not saying that we have to have it. I'm saying that we have it on the agenda, and if we haven't got it, we know why and when it's coming to us. I just don't want to lose it. And Councillor Rice is nodding, so I assume she's comfortable with that.
Okay, noted, yes.
Thank you.
Okay, date of future meeting is 26th of November. All of the evidence is that meeting will be virtual like this one, so much as though that's quite depressing. I look forward to seeing everybody there. I thank everybody for their patience, for their forbearance, and the amount of time they've spent. David Wilkes, I trust you have one final short point to make.
Extremely short. Just to note that we actually have a training day on the 25th as well. Obviously, we won't have a whole day, but I think it would be useful to do a two-hour slot in the morning like we did yesterday prior to the meeting.
Okay, thank you, David. Andy Canning.
I wanted to say, as chairman, a huge thank you, Peter, for you standing in and running the meeting. It's very frustrating when the technology doesn't work. It's the first time it's ever gone wrong for me. Up till now, it's all been perfect out of things I've been on. But for whatever reason, it just refuses to work properly today. And but thank you very much for organising this morning's event very well.
Well, thank you, Andy. I'll get you to apologise to my wife. She's got a brother-in-law here for lunch. But thank you very much. That's part of the pleasure of being here. Again, members, thank you very much, and thank you to all of you who I know give up your time freely, and hopefully your work is well worthwhile. Thank you very much indeed. I'm closing the meeting now. Thank you.
Thank you. Bye.
Bye.
Thank you.
Bye.
Thank you.
Unknown participant is now exiting.